of fixed income strategy. I want to begin with a quote from Terry Haynes of Evercore ISI. He had this to say about Cohen's departure. The narrative will be that protectionists will be in the ascendant and that Treasury Secretary Mnuchin be the lone remaining free trader. It will be eclipsed. Even so, there will be more bark than bite in the Trump protectionist story, the line of the last few days. Investors should understand the Cohen departure as the end of his influence in a difficult White House, but not to overreact to it. George, your thoughts on that we shouldn't overreact to this?
I think that's right. I think that right now you've seen the bond market go a little bit strengthened here, obviously in a risk-off environment. That makes sense. But I think longer term, it's not such a negative for the marketplace and all. And we'll see how it protracts from here. Right?
Noah, would you go with that as well?
I think so. Look, this is not great economic policy. The benefits, even the purported benefits, probably are much smaller or non-existent. The end game could be pretty nasty, but I think you sort of solve backwards from a game theory perspective. Nobody wants this. Nobody benefits from this. And so there's got to be a solution. But it does push you towards a little bit more inflation, a little bit more pressure on margins, which we keep an eye on. It exacerbates some of those pressures potentially.
So, Mark Connors, in the near term, the consensus seems to be that you should fade the drama. The second point, everything's going to be okay. To those 2 points, where do you stand?
Sure. Fade the drama, for certainly, we have the tax legislation, we have global growth coordination, we have Fed and other central banks backing away, allowing markets to go after it. That's all positive. As far as everything's okay, we haven't seen a rate normalization, right? We've had a 35-year drive down, the 10-year from 1580 down to 135 now, trying to get through that 3%. We don't know what that looks like with 20 trillion of debt in the U.S. So everything okay? To be seen.
To be seen, with the president still talking about the potential for tariffs and that trade wars apparently are not so bad.
When we're behind on every single country, trade wars aren't so bad. Do you understand what I mean by that? When we're down by 30 billion, 40 billion, 60 billion, 100 billion, the trade war hurts them, doesn't hurt us.
I want to cross over to Sean Golhar, Barclays Head of Public Policy, who joins us on the phone. Sean, your view on the departure of Gary Cohen and the vacuum that it leaves at the White House. Who fills it?
No, it's obviously a very serious situation here. It's not good for those that want to see free trade and pro-trade policies going forward. But let's also take a step back. The president has said a lot of different comments over time and backtracked on this issue. Navarro came out right away and said there's going to be no exemptions, only to have the president tweet out a talk of possible exemptions with Mexico and Canada, as well as Mnuchin talking about possible exemptions. So it might be the case that, Cohen is leaving, which is going to be detrimental for those in the market and those that want to see free trade deals. But it's also possible the president is going to step back a little bit from some of these more nativistic, nationalistic policies.
So, Sean, just finally, before we lose you, what is your base case over at Barclays right now about what trade policy is going to look like within this White House?
I think we're entering a new phase right now in trade, and at Barclays we put out a note this morning talking about some of the free trade issues. We're entering a new phase now where, he's coming off a few big wins, one on the tax cuts, on the deregulatory efforts. He's been very successful on the court side in appointing and confirming various conservative judges. So now he's potentially moving into a more aggressive trade policy. We're seeing on NAFTA, it's continuing to go along now. We finished that 7th round, but we don't see any clear way that they can get NAFTA done. It is quite possible the president will announce at some point his intention to withdraw from NAFTA. He might use that as an ability to extract concessions from the Mexican and Canadian side. But we're definitely going to see now a more aggressive White House on trade. And keep in mind, with the elections approaching in November, the president may try to use this to win support.
Sean Golhar of Barclays, always great to catch up with you, sir. Thank you. I want to head over to Washington, D.C. and catch up with Kevin Cirilli, Bloomberg's chief Washington correspondent. Kevin, when are we actually going to get the news on this trade proposal and what it actually is and where the exceptions are?
Hey, Jonathan, we just don't know yet. The president has continuously delayed any actual language of releasing this language, and I'm told by sources who work with this White House that that's a sign that he's hearing the criticism that is mounted not just from the international community and the international markets, but also here at home with top Republican leadership, including Speaker Paul Ryan, urging the president to reconsider. Jonathan, last night I spoke with 2 House Republicans who told me that they are circulating actually a letter letter urging President Trump to reconsider. And the top economic team, the remaining team members to President Trump, out in full force this morning, talking with reporters. I just spoke with Commerce Secretary Wilbur Ross, and I asked him point blank, I said, you know, Speaker Ryan's saying he wants a more surgical approach, and he told me, quote, "We are trying to do a surgical approach." The president indicated that if we can work something out with Canada and Mexico, they will be exempted. It's not inconceivable that others could be exempted on a similar basis, end quote. Look, how much does the president care about what the stock market's doing? Every top economic advisor is out talking to reporters this morning.
The charm offensive begins. Kevin, before we lose you, something that I think has been lost in all the drama and has been quite underreported. The Axios story around this departure of Gary Cohn actually indicates that Gary Cohn would be willing to go back to the White House should a bigger job come up. Something that's lost here, maybe, was Gary Cohn just getting bored of the job he was currently in and the lack of influence it had?
I'm going to answer this directly. Yes, and I totally agree. That's been an underreported fact here, and we actually saw a similar situation with Dina Powell. And so, look, I mean, it's a revolving door within Washington and the private sector, and you know, anything is possible in that revolving door. It spins very fast, and also it spins fast inside Trump world.
Bloomberg's Kevin Cirilli. We'll be catching up with you a little bit later for sure. Kevin, bring us some great news and insight from Washington, D.C. I want to cross over to Michael McKee, Bloomberg's international economics and policy correspondent. Michael, a lot got lost in this news of the last 12 hours or so, but something else that got lost is actually they are moving potentially to more curbs of Chinese imports. Just walk me through the specifics around trade and the news we are getting.
Yeah, the question becomes, John, how much does it matter if we do put curbs on Chinese imports? It would be important on a macro sense. Let's take you inside the Bloomberg here and take a look at G1169. This is total imports up here. China is the white line, then Mexico and Canada. So you can see that Mexico and Canada together are about the same as China. It is a fairly large impact, but it is by sector important, not necessarily overall. The U.S. would still be able to buy stuff from other places. Now let's take a look at foreign direct investment. This is one thing that people have been talking about, and that Trump was talking about, putting curbs on China, not letting them invest in anything in the U.S. We can't invest it in there. That's negligible because this is total investment in white. This is what we get from Europe. China's way down here, barely above zero. So it doesn't really register. If we put curbs on them, not going to affect the U.S. economy. And then what happens if they retaliate? Well, my chart kind of moved here. Here's what we can do under the steel sanctions, under WTO rules. China suggests that it's going to play by WTO rules. The Canadians could put $3.2 billion worth of sanctions on us. The European Union, $2.6 billion. China only $689 million because we don't import that much steel or aluminum from China right now. So the overall impact in the short run, rather negligible from sanctions on China. It's a question of the longer run and what happens to global trade if he starts a trade war.
Bloomberg's Michael McKee, great to catch up with you. Let's talk about how the markets are capturing this story with some stock moves and crossover to Bloomberg's Taylor Riggs. Taylor.
John, we're taking a look at the major banks this morning. They are headed lower in pre-market trading. Gary Cohn was really seen as a steady hand, more importantly, a friend to the banks. Of course, he'd worked on corporate taxes, deregulation, all of which the industry had been craving for years. So losing him is seen as a little bit of a loss for the financials. If we flip up the board, we're also taking a look at the tech sector and some of these chip makers. The Trump administration, of course, is looking to curb Chinese imports, investigating China's intellectual property practices. An announcement on tariffs may come in the next few weeks. Consumer electronics may be on that list. You're seeing Apple, Qualcomm, Broadcom, Intel lower this morning. John.
Bloomberg's Taylor Riggs, great work. Thank you. I'm pleased to say that the panel's going to stick with us. Noah Weisberger of Bernstein, Mark Connors of Credit Suisse and George Rusnak of Wells Fargo staying with us for the following conversation. When a dove starts to turn hawkish, it's Fed Governor Brainerd striking an optimistic tone about the U.S. economy. That's coming up next. About 19 minutes away from the opening bout, the story looks like this. Futures bounce off the lows, down by about 0.7% on S&P futures. Dow futures, though, still down by around about 1 full percentage point. From New York, you're watching Bloomberg. About 16 minutes away from the opening bell in New York City, a snowy, cold New York City with futures bleeding lower by about 0.7%, down 19 ahead of the opening bell. From the Federal Reserve, it's a message of hawkish optimism from one of the Fed's biggest doves. Fed Governor Lyle Brainerd telling an audience in New York that she supports continued gradual rate hikes and that global growth and fiscal stimulus are aligned to support the United States economy going forward.
In many respects, the macro environment today is the mirror image of the environment we confronted a couple of years ago. In the earlier period, strong headwinds sapped the momentum of the recovery and weighed down the path of policy. Today, with headwinds shifting to tailwinds, the reverse could be true.
Still with us, Noah Weisberger of Bernstein, Mark Connors of Credit Suisse and George Rusnak of Wells Fargo. Mark Connors, upside risk to rates. Never mind the drama in Washington, D.C. The fundamentals of this economy is pushing even the biggest dove over at the Federal Reserve to think about more hikes.
Right. So when you look at U.S., you can't not look at the whole rate environment complex.
Yeah.
If you were to look at the 10-year bond versus the 10-year Treasury since, say, '89, that spread averaged probably 100, 110 basis points, right? It is now at 220. It's exactly where it was when it peaked in December of 16 after the Trump election, when people were deficit friendly and thought that rates were going higher. It expanded. So the point is, we can say what we want to do, but we are connected to the global economy, and it's a global marketplace, and we're not going to go much higher if the DAX is at, or the 10 years at 69 basis.
Are you saying basically that treasuries can't continue to sell off in a vacuum until bond yields catch up? Is that a message?
Correct, yes. It is. We're all one water table. So when we try to talk about rates going higher, we are connected, right? And that's why the trade is such a big topic for today.
George?
I think they have sold off a little bit, right? So 10 years actually have pulled up a little bit since then. And from our perspective, you know, again, there's some large forces at play here, right? And I think what people are getting lost in is the idea of the degree of magnitude, right? So the idea that interest rates are up, inflation's up, volatility's up, yes, but they were extremely low. And so they're up to sort of what we would call moderate levels, and we're not necessarily concerned about that getting out of hand. We do think that the Fed will be raising rates roughly 3 times this year. It's pretty much baked in for March, likely in February. Then it becomes a little bit more questionable in September and in December. Our base case is that one of those two they'll raise it, but not both.
Now, I caught up with Deutsche Bank this morning, who were talking about 4 with upside risk of 5. It just seems that the narrative is running away with itself a little bit at the moment. What's your view?
Definitely the narrative has a risk of running away. This is, you know, it's a healthy environment still for equities, my perspective.
Yeah.
We're going to see more on the earnings side. Fourth quarter was great. We're talking about trade wars, as you say, but really the narrative should be how strong the February data were. You know, we've had these first quarter slumps for the last couple of years. We're probably not going to see that. This should be a great time to be still long equities. That's our view. And the rate market, it was a big adjustment at the start of the year. And I think that's what got the February equity market sell-off going. But the market can digest big moves, takes a little bit of time, and higher rates, higher equities, driven by growth. That seems like a good environment to me.
If you just read the front page of the newspapers over the last 5 days, George, you would have thought the price action was ugly, 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 and it's just not. We just got away the 3rd biggest credit deal ever with CVS's issuance to buy Aetna. I mean, we're talking about massive issuance still coming into this market, even with the drama elsewhere.
It's interesting because the larger narrative is that the central banks are obviously pulling away from the buy side. So demand is actually pulling away from the market, yet the market is still strong, right? And there are other players that are stepping in. Pensions, life insurance companies, individuals are stepping in to fill that gap nicely. And we do see a pretty strong market right now.
Mark Connors, did you see that continuing, this resistance that you see, these real strength you're still seeing capital markets, regardless of this conversation about higher rates from the Fed?
Yeah, so the demand for products there, equities certainly, but for credit, you know, we talk about the demand. Look at the longer-term demographics, right? There's a liability-driven investing, so the demand for
In the Asian local currency space, we still see some opportunities in pockets of Asian markets. For example, we are looking at the Korean bond markets. The market has priced in some rate hikes at the moment, but
changing and shifting a little bit, and so we think it's now smart to start moving down on the curve to start moving up in credit quality.
Noah, your view?
Well, I think that not just the rate market, but financial conditions generally still are pretty accommodative, and I think that can keep, at least from an equity perspective, should help to support the rally or at least stem some of the risk-off moves that we're seeing. And I think that's what we're focusing on. It'll be a little bit less multiple, a little bit more on the top line.
Just in terms of financial conditions staying easy, how much longer can that go on for? Because one of the benefits the Federal Reserve had was the ECB staying in the game big time. As we've learned over the last couple of months, the ECB might not be staying in the game. Does that change things?
It'll start to move. You benefit from a lot of dollar weakness as well, and some of the tightness in the credit markets. And so if those start to widen a little bit, I think but you're coming from very, very low levels. I think the point made earlier is a good one, which is take a step back and see where we are generally in terms of levels, and things still are really very supportive.
Well, Mark, I just wonder whether we're taking loose financial conditions for granted. We've gotten used to almost conditioned by a Federal Reserve that can hike and financial conditions that can stay loose. Are we about to hit an inflection point where hiking does actually mean tighter financial conditions?
I think the folks in charge want that to be walked up to the point that George made about acclimation. They're going to see how it goes. They're going to float trial balloons. If it doesn't work, they'll come back in. So they're going to release the balance sheet. They're going to release policy, but a little bit at a time.
Raises the question then, is the Fed leading the market leading the Fed, or is it a delicate dance between both parties?
It's absolutely a delicate dance. It is inextricably linked. It has not released. But to your point about the front end, we're seeing some dispersion in markets, which means that the Fed is losing control or it's going back to the market. So that's constructive for some asset managers.
Is that constructive, George?
They run the risk of flattening the curve too much, right, and potentially inverting the curve. We ran into that problem late last fall, and since then it's actually steepened. So 2 to 10s were roughly around 55 basis points. They've actually gapped out a little bit to 70, 75 basis points. So we've seen a little bit of a steepening yield curve. If they keep moving up too much, you could run the concern of a flattening or negative yield curve, which, again, typically has a high correlation with a recession coming on.
George Rusnak of Wells Fargo. Staying with us alongside Mark Connors of Credit Suisse and Noah Weisberger of Bernstein. Coming up on the program, Netflix hit with a rare downgrade. Up next, the company's biggest bull explains why he still sees the stock hitting $400 a share. That's coming up in our morning calls. In a market about 9 minutes away from the cash open in New York, the story as follows. Futures soft, down by almost 0.75% on the S&P. The Dow down by 0.97%. From New York, this is Bloomberg. The opening bell in New York, 7 minutes away. The story as follows. Yes, the weather sucks. but futures are soft, down across the board, down by about 0.8%, off by 21 points on the S&P 500. It's time now for the morning calls, a look at some of the big movers on the back of analyst recommendations. First up, we begin with on the street, R.W. Baird raising its price target on Urban Outfitters up to $42 a share. The analyst saying the consumer looks healthy again and comps should be easing. The story elsewhere, next, Deutsche Bank reiterating its sell rating on General Electric. The analyst saying GE is among the most at risk from Trump's tariffs. And finally, Stifel, a long-time Netflix bull, downgrading shares to a hold from a buy. The analyst citing valuation concerns after a 69% rally thus far in 2018. That downgrade coming just after a new top bull emerged yesterday. Pivotal Research raising their price target to a street high of $400. Joining us on the phone now, I'm pleased to say, is Jeff Voldacek, Pivotal Research Group CEO. Jeff, great to have you with us on the program. Talk to me about why subscriber growth and growth full stop can continue justifying some of these gains on this stock.
Yeah, good morning. I think, first of all, fourth quarter results, I mean, there's a logical reason why the stock's up 69% this year. Netflix raised their pricing just over 10% in the fourth quarter and yet managed to blow away subscriber expectations. And I think, that's a very, very powerful model when you can take price and also continue to beat on subs. And I think at the end of the day, there's still a long runway for growth, not only on subscribers, but on ARPU, and that's globally.
Jeff, when does the cost of that growth, the amount of money they have to spend on content, when does the cost of growth become a metric this market worries about?
Well, I think the market will worry about it if subscriber growth starts to slow down. Then the market will get worried about, will they be overwhelmed by their content costs? But right now, I think they operate in a virtuous circle where effectively the more content they add reduces churn for their existing subs. It allows them to attract more subs going forward and allows them to take price. I mean, this in 2017, Netflix average ARPU per customer is $10. While Comcast isn't a direct competitor, their video ARPU in 2017 was $86. So you're getting a tremendous commercial-free entertainment alternative at what is still a very inexpensive price.
Jeff, just quickly before we let you go, the issue of competition, are you worried about any competitors actually really ramping up and starting to take a bite out of Netflix?
I think the thing to always, the entity to always focus on, and this is in literally any industry, is Amazon. But I think both of them that can survive here. I mean, you think about media companies, their problem is, they're still beholden to the current pay TV model. I mean, Disney generates a very large percentage, as an example, of their operating cash flow from a pay TV business, which isn't doing very well.
Yeah.
And at the end of the day, do you want to create a product that can compete against Netflix and drive people away from pay TV, which is their core business? So I think Netflix is very well positioned.
Pivotal Research. We've got to leave it there, sir. Thank you. This is Bloomberg. 25 seconds away from the opening bell in New York City after Wall Street loses one of its own at the White House. Futures a little bit softer here. I say a little. We roll over going into the cash open. Dow futures down by over 1 full percentage point. S&P 500 futures down by around about 0.8%. As you hear the opening bell ring in New York City, switch up the board. The story of the bond market looked like this. A bid comes into Treasuries. Yields lower by 3 basis points to 286 on a US 10-year. Euro dollar unchanged, really. I've got to say, FX is pretty quiet here. 124.16. We're up by about 0.1%. And crude rolls over to $62 and around about 10 cents. With me in New York, I'm pleased to say, the panel as follows: Niall Wolfsberger of Bernstein, Mark Connors of Credit Suisse, and George Rusnak of Wells Fargo. Now, just to begin with you, we have not got paid, investors have not got paid over the last decade or so to worry about things like this. But every time we get something like this, we roll over. How do you carry on shrugging off some of the noise, or is it news that continues to bleed through from Washington, D.C.?
I think it's noise. I think you need to have a framework and focus on the things that you think matter. We've looked hard for areas of market excess that tend to precede recessions and market downturns, and we can't find them. I mean, the bond market, the U.S. Treasury market is probably the asset that's most richly valued. It's a very different kind of animal. And so short of those signals, we think we're mid to late cycle, and you may switch around your sector allocations. You need to think about a slightly higher vol environment and a higher rate environment, but we think that's the lodestar to focus on.
Mark Connors?
Yeah, point. It's going to be different. You're not going to have a unilateral lift in every sector, every asset class, because you have a backstop. So you have to go to your fundamentals, as you said, have a framework, know what your objectives are. A pension fund probably wants uncorrelated returns because of the tax advantage and their daily outlays. A person who's got a bunch of kids who wants to pay for college probably wants to be heavier in equities. So what do you want to do? You want to know what your game plan is, and know that there will be winners and losers. What has happened in the last 5 years will not be the way it goes going forward.
George Rusnak?
Yeah, I think that's true. You definitely have to recognize a change in dynamic, and specifically, you know, for a fixed income perspective, again, you can take any kind of risk and you're rewarded with that. And we think that you're going to have to dial back those risks, whether it's interest rate risk or credit risk. It's a good time to change that dynamic.
So the market's right now about 2 minutes into the session. We are on the back foot. We're down about 0.8% on the S&P 500, down by over 1% on the Dow. Let's get you some moves and cross over to Julie Hyman. Jules.
Well, I want to start first with the retailers here today. We'll get to the whole trade discussion in just a moment, but you've got Dollar Tree stores trading sharply lower even after the company came out with some mixed results here. It missed its fourth quarter results by a penny, though. First quarter forecast also missing. Comparable sales up 2.4%, but that's slightly worse than estimates. Ross stores more mixed. That was actually what I was thinking of. Comparable sales there up 5%. That's better than estimated. Earnings beating estimates. However, the company's forecast for the full year is a bit conservative. An analyst over RBC, Brian Tunick, is saying investors were looking for more of a tax benefit in the full year earnings per share forecast. And then you have Urban Outfitters. That company's numbers beating. Its margins did fall in the fourth quarter because of higher delivery costs, and that was slowing down the shares earlier in the pre-market, but now they have turned higher by 1%. Now let's get to the fallout from Gary Cohn's departure and the continuing concerns over tariffs and a trade war. It appears to be hitting the financials today for a couple of different reasons. First of all, there was some concern here that the tariffs could lead to potentially slower lending because of lower economic activity. And then Cohn, of course, was seen as an ally of the industry in the White House. So financials, when I was first checking here out of the gate, were the biggest laggard within the groups on the S&P 500. And by the way, all of those groups are trading lower out of the gate this morning. And then, of course, you have the industrials as well. What is the effect of the tariffs going to be? There are still a lot of questions about it. Caterpillar and Boeing both down. That's why we have the Dow underperforming as we get underway this morning. And as you might imagine, the steelmakers are outperforming as it looks ever more sure that the tariffs are indeed going to be going into effect. U.S. Steel and AK Steel, just a couple of examples, John.
Julie Hyman, great work. Thank you very much. Mark Connors mentioning what do you do to get uncorrelated diversification. I caught up with Laurie Haenel of State Street Global Advisors, the Chief Investment Officer, saying you can't hide in treasuries.
There is no risk mitigating asset. I mean, I agree with what was said earlier. Cash is really the only thing there because we are in an environment where rates are going to go higher. The question is how quickly they go higher. We are in an environment where there are lots of risks out there that may not be priced into the market yet. And so there really isn't any safe place to hide.
George Rusnak, the idea that you can't hide in treasuries anymore is quite a shift. That's a big change.
Yeah, I think that most people think that, just because you're in fixed income, you can't lose money. And I think that's a different interest rate environment that we've seen more recently here. Yeah. And it potentially could pick up as we get closer to year end.
Mark, what are your thoughts on this? Because when I asked the panel of guests about this, what is the risk mitigating asset? And they said, well, it's not treasuries anymore. It's all about liquidity. But then I turned around to them, when I think of liquidity, I think of treasuries.
Right.
So what is it?
So I think then you talk about treasuries. Is it front end? Is it long end? So you reduce duration risk. So you stay in the front end, which is cash.
Yeah.
And again, historical. Take a step back. We wrote a piece called Trading Places about the Eddie Murphy movie. Not just to be cheeky, but that period when Volcker took office between 79 and 81 marked the transition from rates to commodities. When bonds became king, commodities ceded leadership, that's where you have to look. There is risk in the middle of the curve, end of the curve, in rates, and still have to have allocation, but this will be different. We haven't seen this in 35 years.
So wait a sec, to be clear, are you saying that we're pivoting to a world where if you want uncorrelated diversification, you need to find it in commodities?
So that is where a lot of the hedge funds have migrated. And again, we were talking about energy and the difference between sort of commodity versus the equity. The commodity has performed, and the equity is not necessarily the case.
And now lift the lid on the equity market for me and talk to me about how this dynamic applies to you.
In terms of commodities, or commodity exposure, we happen to like the energy sector. It's a value play for some. It's a small market weight, so it's hard to get traction with some investors. With a benchmark, they can kind of ignore it. But if you're looking for value, it's there, and there's a lot of catch-up room to the commodity itself.
George, does credit become more of a haven play than, say, treasuries? Is that how you've got to think about this in some kind of counterintuitive way?
Yeah, I think, again, you want to dial back your risks right now, but I think, if you look at the part of the curve, right, and where the opportunities are,
yeah.
2-year treasuries moved up 70 basis points last year, yet you still gained 19 basis points, right? So you didn't actually lose money in that, right? So because of the backup in this short part of the Euro curve, we do think there's more opportunity there. The risk and reward is further out in the curve on the intermediate, and especially on the long end.
I keep coming back to this question, but I think it's important, Mark. Are we concluding that the biggest risk right now is in the risk-free asset?
Yeah, from a price basis, yes, barring the R word that we mentioned earlier about recession. Right, so unless we have a change in the credit dynamics and a default cycle kicking in, then yes.
Well, let's test the extremes of this because I think it's important. Barring the R word, the recession, let's war game that out. You get the recession, let's say it's years down the road, but ultimately we see a budget deficit that's as wide as it is now without a recession, approaching 5% of GDP. Do you get to a situation where you start actually trading a lot of sovereigns, more than just the periphery in Europe, as credits? And not sovereigns.
Right.
And that traditional safety play of going to treasuries at a time of recession might actually change a bit.
We just went down the rabbit hole here, right?
Let's do it. We're there already.
Yeah, we're talking offline about that, and the case is we were there for a moment in time in 2010.
Yeah.
And if you look at the dynamics of debt to GDP, they have not improved. So I think if balance sheets give up, the central bank balance sheets sort of give way in that, what do they call it, the coordinated ECB banking union, right,
yeah.
for all intents and purposes, gives way, you'll see spreads widen and diversification. So the rabbit hole, will emerge.
George, weigh in.
I think the ECB is obviously the backstop in Europe right now. And so the question is how quickly and what's their pace and to what degree do they actually start removing some of their stimulus that they've had. And they've gone very slow, and our base case is that they'll continue to go slow. They're dealing with 17 different countries that they have to manage through, and also their complexity of what they invested in. So U.S. invested from a quantitative easing perspective in both treasuries and mortgage backs. They extended out to corporates. They also have the capital key ratios to deal with. So they have many constituencies, many complexities, and we're behind us. So it's going to be a much slower path out of the ECB.
They have done a ton of work, and we've gone off piece, so we might as well stay there. Yet still, European periphery still trades like credit. It doesn't trade like a sovereign. It still trades like a credit, and that hasn't changed.
And it hasn't changed because the ECB is still the backstop. So what they have to do is start removing that backstop. They have to start removing their quantitative easing. And as they start doing it and then start normalizing rates, we'll start seeing things behave the way they normally should.
I still sit here and think about what is normal and how self-limiting any kind of ambition will be to try and pull away from all of this. You've got high yield in Europe that has a one handle on some of the coupons. You have the credit in terms of the yield trading below the sovereign in a place like Italy, George. It is fancy land in fixed income in Europe still.
It doesn't make sense, but it makes sense in the sense of what the dynamic is, meaning that if the ECB is telling you what they're going to buy, when they're going to buy, you have a natural backstop. From a trader's perspective, you position for that. And that causes those distortions in the market that we're talking about right now.
Yeah.
The key is they need to remove that, and therefore they'll remove the distortions. There's going to be volatility as a result of that. We're seeing some of the volatility here in the U.S.
I know, but I guess my question, Mark, is that economic fundamentals will never justify the price action in Europe.
Not
economic ever. The idea that high yield should trade with a one handle over in Europe?
Not today. And to the point of, your audience, if they're in active packaged products, passive products, that's something to be aware of because, again, differentiation has been smushed because of this suction of risk out onto the balance sheet and the backs of the ECB, like you just mentioned. If that ever blows back, and again, if it ever does, you're going to see movement between assets that you haven't seen before. So that's that active versus passive dynamic where passive grew exponentially. If we start to see normalization from rate hiking and recessions, that's going to unwind.
Mark Connors of Credit Suisse staying with us alongside George Rusnak of Wells Fargo Investment Institute. Our special thanks to Noah Weisberger of Bernstein. In the markets then, about 11 minutes into the session, the story as follows. Equities softer here, down 0.5% on the S&P 500, off by about 13 points, down 0.6 on the Dow. No real drama compared to the drama that is engulfing this White House once again over the last 24 hours. In the bond market, Treasuries do receive a bid. Yields are lower by just a single basis point now at 287. And you've got to say there is a curious quiet in the FX market that we will discuss in just a moment. From New York, this is Bloomberg.
This is Bloomberg Markets The Open. I'm Kaylee Lyons here in the Hewlett-Packard Enterprise Green Room. Coming up in the next hour of Bloomberg Markets, Jan Hatzius, Goldman Sachs chief economist.
This is Bloomberg The Open. I'm Jonathan Ferro. About 15 minutes into the session, some breaking news on Airbus. I want to cross over to Taylor Riggs.
John, yes, Airbus confirming its adjusted production rates for the A380 and the A400 programs, coming out and saying they're planning for 6 A380s a year, 8 A400 a year from 2020. The measures could affect up to 3,700 jobs. Airbus then saying they are confident they will find opportunities for most of these staff that will be affected. So again, about 6 A380s a year and 8 A400s a year from about 2020, 3,700 jobs affected. John.
Taylor Ricks, nice work, thank you. In the FX market, a curious quiet. The dollar weakness, well, it remains amid mounting concerns of a trade war and a growing US deficit. This, as other currencies, are emerging unscathed. If I told you that over the last 5 days, the Mexican peso would remain nearly unchanged, you might have laughed me out of the room. Still with me, George Rusnak of Wells Fargo Investment Institute and Mark Connors of Credit Suisse. We can have a look at what emerging market currencies have done over the last 5 days. And I was surprised just to bring up the terminal this morning and just go through it. The peso, dead flat against the US dollar. The Thai baht, dead flat against the US dollar. These are all sort of proxies that I would have thought that any kind of trade war rhetoric, these currencies would have been punished. Why not?
Yeah, so I guess people are looking through the messaging out of the White House, last couple of days. But the point that we were talking about, absolutely, currencies you have to look at, because whenever there's a big shock, market shock, whether you look at August 15, you look at January 2016, currency devaluations were involved, or January of 15 when we saw that movement. Yeah. So you're right to look at it. The fact that it's stable, I think, means what we were talking about earlier. People are looking forward towards this global coordinated growth, the equity market moving higher.
So you were saying in a world of risk aversion, we talked about this earlier, maybe you're not going to treasuries anymore, but you don't seem to be going to the US dollar anymore either, George. Something is changing where the United States has become the risk issue, and that in terms of risk aversion, the money is going elsewhere.
Sounds odd to say that, but I agree. I think two things that are going on. One is inflation expectations have been ramping up. Yeah. And certainly volatility has been ramping up. So you've had some large carry trades that are great in a low volatility environment that are kind of unwinding themselves. And then obviously you have inflation picking up, and that's been very harmful to the US dollar.
So Mark Connors, going forward, it just tells me what I learned last year, that rate differentials aren't going to explain the price action in global markets, in global FX.
Right. So there's a bit of a separation for sure, and I think George's point about inflection points, people may be reassessing the linkages that were there in the past. The U.S. is a distinct animal here as far as the growth prospects, as opposed to the debt to GDP that they have, and the twin deficits now, the new term being thrown out.
So how do you take a view, shape a view on emerging markets with the rhetoric that you have in Washington, D.C., but at the same time the price action not really meeting the rhetoric in any way, shape or form? Do you ignore this administration when it comes to developing trades in emerging markets?
Now, let me answer your question about EM. When we look at EM, there's sort of while you were sleeping, right? Since the last recession, emerging markets have gone from, say, 20 years ago, 19% of GDP to 30%. They're 44% of global GDP is in emerging economies per the World Bank. So when you look at who's got the balance of power and where currency movements are going to be evolving, I think the dollar's preeminence may be tested. That's what I think is a potential.
George, would you go with that?
I would say, yes, I believe in the growth, but I also believe their access to the markets is better. Their ability to, their floating currencies are better, and their actually ability to trade with one another has improved greatly. And we just think that's actually a good growth story from a long-term perspective, both in the equity and bond market.
So speaking to a lot of your peers in the world of fixed income who are very bullish on emerging market assets, if you have this view on FX, what does it mean about your FX exposure as you take FX risk in emerging markets? Are you more comfortable doing that, just buying local currency bonds?
We are, and it's actually part of the total return that we're looking into. So not as much in the developed market, we want to hedge that out a little bit, but more on the emerging market side, we actually like getting currency risk.
Would you be comfortable doing that at the moment?
It depends on your liability structure, right? If you have a short-term investor base and you're trading local, may not be the best mix, because emerging markets are coiled springs. You don't see the risk priced in every day there. So it is the opportunity. People are definitely talking and doing that. You better make sure you can hold on to that trade when vol comes.
George?
Yeah, I agree. You have to worry about the volatility, but also that's part of the market, right? You have to weigh risk and reward, and we just believe there's more reward there.
Just as a final note, before I let both of you guys go, when clients start calling you this morning and you start talking about this market and Gary Cohn leaving, in some ways we are in an echo chamber here on Wall Street because Gary Cohn means so much to so many people on Wall Street. For the rest of the world, Gary Cohn isn't that representative messiah of the street over in the administration. How do you communicate to clients this morning that actually this isn't as dramatic as it seems to a lot of people sitting in New York or waking up in California in the bond shops? What do you say to them?
Well, I think fiscal policy takes time to bear out. It isn't one person. We have 3 branches of government. Fed policy still trumps everything. No pun, but maybe. And so as far as the narrative, yeah, we're more sensitive to it because we're familiar. But as things bear out, you have to look at fiscal takes a while. Tax legislation is the driving factor near term.
George?
Yeah, I think this is, we get caught up in sometimes in sort of these changes that happen. And quite frankly, there have been a lot of changes that have happened to his administration. It actually still keeps going along, and hopefully more of the growth policies move forward rather than the trade tariff policies, and that's what our hope is.
George Rusnak of Wells Fargo Investment Institute. Been great to catch up with you as well. Mark Connors of Credit Suisse. About 20 minutes into the session, a story cross-asset as follows. Equities here in the United States as follows. Down by about 0.6% on the S&P 500, off by 0.75% on the Dow. In the bond market, a story as follows. Treasuries yields lower by 2 basis points to 287, and that quiet in the FX market with some marginal yen strength continues. Just south of 106 on dollar yen, euro dollar reclaiming a 124 handle ahead of that ECB decision and President Mario Draghi news conference coming up tomorrow. This is Bloomberg. This is Bloomberg Markets, The Open. I'm Jonathan Ferro. It's time now for the trading diary. What you need to be watching in the days ahead. At 2 p.m. Eastern Time, we get the Fed's Beige Book. Thursday is the European Central Bank's rate decision, followed by a news conference with the man himself, the chief, the president, Mario Draghi. Then Friday, a less talked about Bank of Japan decision with Haruhiko Kuroda. And then it's the big one here in the United States. It is Payrolls Friday. Joining us now for some final thoughts is Bloomberg's Lisa Abramowitz as she gets ready for Bloomberg Radio with Pim Fox a little bit later. Lisa, what are you looking at this morning, given the drama down in Washington, D.C. and the price action on the screen?
What I'm looking at is inflation expectations, because a lot of people think that a trade war, which people think is increasingly likely now that Gary Cohn has left as economic advisor to the White House, would raise consumer prices in the U.S. This has been basically the vast consensus. And if you look at futures contracts, in particular 5-year break-even contracts, you can see that they've risen to the highest levels since 2013. What is this implying? It implies that the inflation rate over the next 5 years is expected now to be the highest since 2013. That's interesting to me. It's especially interesting in the light that longer-term inflation expectations are falling. This is saying people are getting worried about stagflation again.
Or are they getting worried that the Fed's just going to cut all of this off?
Well, either it's the Fed, right? Or it's the fact that you're going to get a short-term pop right now, and what that's going to lead to is higher benchmark borrowing costs, because inflation and borrowing costs are very closely linked. Those two continue to rise. That will cut off growth with or without the Fed.
What's clear is that the Federal Reserve seems determined to carry on hiking here, and it doesn't matter what happens in the market. We saw the Federal Reserve, the bulk of it, even the likes of President Dudley of the New York Fed, shrug off the volatility of the last month or so. He still wants to see more rate hikes. And then we saw the uber dove, Lyle Brainerd of the Federal Reserve, coming out and basically suggesting more hikes ahead, more hikes should come.
Well, honestly, they're really walking a tightrope right now, because longer-term yields are going to rise, and frankly, shorter-term ones are as well if inflation is going to pick up. If they get behind the curve, that could be much more painful. So they have to be very sensitive and on their toes.
Is that your takeaway at the moment, that the Federal Reserve is becoming increasingly sensitive to getting caught behind the curve, and that the tax policy of this administration has almost accelerated that process and brought it forward?
Absolutely. I mean, you hear about the risks being balanced on both sides in all of this talk, which is a marked shift from a few years back when people were worried about never getting up to that inflation target. I mean, to be clear, inflation is still pretty low, but right now there is a concern that they're behind the curve.
A final thought: you sat in this chair this time yesterday and talked about key man risk in the shape of Gary Cohn. Did Gary Cohn make the position that he held a lot more bigger than it actually is? Because I don't remember doing this with Gene Sperling. If he stepped down, markets would plunge. There just seems to be, we've put on a lot of weight on the shoulders of that particular position within this administration.
That's true. I think that there is a level of fear. Who is left in the White House with the competence and the experience to navigate a potentially turbulent market and to navigate sensible economic policies? And right now, it's not clear who's driving the ship and whether anybody who has a fundamental understanding of markets and Wall Street is available to President
Just in
Trump.
terms of the timing, the spokesperson for the White House, Sarah Huckabee Sanders, saying that the tariffs are on track to be signed by the end of the week. So there you go. If you were looking for a date on when those proposals might become a law, that is what we know from the White House so far. Bloomberg's Lisa Abramowitz, thank you very much. This was the countdown to the Open. You're watching Bloomberg TV.
10 a.m. in New York, 3 p.m. in London, and 11 p.m. in Hong Kong. From New York, I'm Bonnie Quinn.
And live from London, I'm Mark Barton. Welcome to Bloomberg Markets.
Here are the top stories we're covering from the Bloomberg and around the world. Cohn quits, stocks drop. Cohn's departure seen as a victory for protectionists in the White House. Investors now worried about tariffs and trade wars. We'll talk with Cohn's former colleagues at Goldman Sachs. Chief economist Jan Hatzius up first. His take on what tariffs could do to the economy. And big changes could be coming to banking regulation as lawmakers consider changes to the Dodd-Frank rules. We'll speak with a key congressman in this debate. All that and much more, including a Nobel Peace Prize winner this hour. But we are 30 minutes into the trading day in the U.S. Bloomberg's Abigail Doolittle is here.
Yeah, and the bears are out this morning, Bonnie. We're looking at declines for the major averages, the worst day in about a week. Although it's worth noting we're well off the lows. At the lows, the Dow had been down more than 300 points, down more than 1%. Both the S&P 500 and the NASDAQ at that point down about 0.8%. So again, off of the lows, but Bonnie was mentioning the renewed fears around a trade war. If we take a look at a two-day chart of the E-mini, the S&P 500 E-mini futures, we are going to see that Cohn effect. Gary Cohn's resignation as economic advisor to President Trump in the White House really caused a big decline in the futures yesterday, down at the lows, down about 1.5% as investors fear perhaps two things. Perhaps, first, the fact that it could mean that tariffs are more likely from the White House. And second, some are saying that Gary Cohn was considered to be the voice of reason within the White House, and that voice of reason is now gone. But we do certainly see declines, but well off the lows. Now, some names being hit on the possibility of a trade war or tariffs being imposed. We're taking a look at Deere, Caterpillar, Nike, and General Motors. Some of these industrial and manufacturing names, they could really suffer from greater input cost of aluminum and steel if those tariffs are imposed. Plus, if there is a trade war, it could certainly hurt any business abroad. In fact, GM down more than 5% since the possibility erupted last Thursday. And then finally, Mark, if we go cross asset class, we're going to see that there is a little bit of a risk off tone here, but not too significant. We do have bonds trading slightly higher. We also have the yen trading slightly higher, Mark, and then the VIX, that fear gauge, Mark, up ever so slightly, but still below that 20 mark. So right now there are declines for stocks, but not confirmed in a huge way when we go cross asset class, Mark.
Abigail, there's been a Cohn effect here as well. We were down by roughly 0.6% at 11 o'clock local time, London time. We're off the lows of the day. We're unchanged on the day. Earlier, it was miners, it was autos, those industries that'll be hit hard by the proposed tariffs, still leading today's decline. But we're unchanged on the day. If we rise today, it'll be the third in a row, and it'll be the best run since mid-February. So that's the stock 600, unchanged, off the lows of the day. Big data out of the Eurozone today. GDP, faster exports, a rebound in investment in the fourth quarter, propelling the Eurozone economy to its strongest annual growth in a decade. Trade contributing 0.4 percentage point to GDP. We also had capital spending give a boost of 0.2. That means the economy expanded 0.6% versus the third quarter, matching the earlier estimate. The data confirming the broad-based nature of the economic upswing. More recent reports, it has to be said, have hinted at a moderation in momentum. That was the big data piece. This is the euro against the dollar, rising for a fifth consecutive day. Best run since February the 15th, highest since February the 15th. The euro having snapped a 3-month rally in February. The ECB may not allude to the currency strength. It meets, of course, tomorrow. Policymakers may instead be content with tweaking their forward guidance, say analysts. Recent news events, including that anti-establishment surge in Italy, underpin the argument for policymakers led by Draghi to avoid any sudden moves. Still, surprises, analysts say, could still come in the form of fresh quarterly projections from ECB staff economists. That's the biggie tomorrow. This is the biggie today when it comes to share price moves. Rolls-Royce, not the car, the engine manufacturer. Shares up by 11%, rose earlier as much as 15%. Biggest increase since 2004. The engine giant pledging to deepen restructuring efforts after Chief Executive Warren East's initial job cuts and cost cuts helped it to overcome years of earnings declines. He's eliminated about 800 management posts. He's slimmed down the unwieldy structure, and he's cut more than 4,000 jobs at the Marine Division. The measures are helping to tap the potential of this record order backlog, Vonnie. Much of the profit gain come from the Power Systems Division. Some key engine models are experiencing performance issues, but investors focusing on the positive, sending the shares, Vonnie, up by over 11% today.
A lot going on this Wednesday, Mark, that's for sure. Well, Goldman Sachs' annual Housing and Consumer Finance Conference also underway. That's taking place here in New York City. The event, of course, coming on the heels of former Goldman Sachs President Gary Cohn's departure from the White House. For sure, that will be talked about around the water coolers. Bloomberg's Julia Chatterley is there now with Goldman's top economist. Julia, take it away.
Thank you very much, Vonnie. Yes, yet to see the red carpet rolled out here for Gary Cohn's ancestral home here, but I am joined by their chief economist, Jan Hatzius, as I mentioned there. Let's start with the exit stage left of Gary Cohn from the White House. How do you recalibrate your thinking on policy here, economic policy, in light of his decision?
Well, I think it raises the uncertainty somewhat. Gary's views are well known in terms of trade policy and generally an approach that's more market-oriented in a number of areas. There are still a number of people with those views in the administration, but there's a little bit more uncertainty. We don't know who the new National Economic Council director is going to be. A number of names have been floated, but I think it's too early to tell. So I think what we do know is that there is a tariff step. The steel and aluminum tariffs will have some impact. They will, incrementally increase inflation, but so far the size of what we've seen in and of itself from a macro perspective isn't that big. The question is really what comes next, and I think it's a little too early to tell what the outcome is going to be.
I mean, you used the word modest here, less than 2% of US imports. In terms of a possible inflationary impact, you're saying 2 to 3 basis points. I mean, it's teeny tiny. The big question here is this the beginning of something far larger?
That's right. I mean, this is something that can have an impact that's meaningful on specific industries. If you look at areas like autos or consumer staples, it obviously makes more of an impact there. But from a macro perspective, this is not something that leads me to significantly recalibrate my thinking about what growth is going to be, or what the Fed's going to do, or what's going to happen to inflation at this point.
What about NAFTA? Because I think this is another angle that people will look at here. The Canadians are up in arms in particular as a result of this potential announcement, significant over tariffs. Are you more alarmed about the prospects for NAFTA here in light of Gary Cohn, but also obviously what we've seen in terms of tariffs?
Incrementally, yes, although we were already pretty concerned about an announcement that the U.S. might pull out of NAFTA. I mean, the probabilities of that have kind of gone up and down. We thought actually very early in the year that the risk of that was quite high. Then it seemed like that was taking a little bit more of a back seat again. Now again, there are some additional questions about whether that's going to happen. Obviously, politically, there are also a number of problems for trade negotiations like NAFTA. We've got an election coming up in Mexico in July. We've got the U.S. midterms. So that risk is definitely out there.
What about China here as well? Because I keep bringing it back to Gary Cohn, but I feel like I need to. He was a strategic relationship manager with all of these countries, and I'm sure a lot of them are like, who do we deal with now? How concerned
they're going to have some of the same questions, I think, that you and I have, and we'll see how quickly we get more of a sense of who the White House spokesman for economic policy and for trade policy is going to be. And I think at the moment it's just harder to know, because there are a number of different people who have a lot of influence in that area, but but Gary was obviously the director of the NEC.
Step forward another Goldmanite, of course, Stephen Mnuchin, clearly in the hot seat probably at this point, as well as a negotiator. Tie all the threads together for me. As you said, you were already pretty alarmed about NAFTA. The impact ultimately in isolation of the tariffs on aluminium and steel, not that much of an impact as far as the US economy is concerned. Just give us your outlook, because we are talking about housing, finance, the consumer here in particular.
Yeah, we've talked about the risks and the negatives, but that shouldn't overshadow the fact
yes.
that, well, not only that there are positives, but also that our overall outlook for the global economy and the US economy is quite positive. We think the global economy is, growing in the 4% range, maybe even a little bit better. You look at some of the high-frequency indicators that we monitor, and those numbers have been even stronger. The U.S. is growing, we think between 2.5% and 3%, well above trend. The unemployment rate's coming down from levels that are already very low. We're getting a fiscal boost, so maybe the financial conditions boost that helped us last year is going to be a little smaller this year, but we're getting the fiscal boost, which wasn't there last year. So, I think it's still a very robust outlook, and probably an outlook for gradual increases in inflation and continued gradual increases in interest rates. That's probably our strongest view if you look at where we are relative to others or where the market's priced, that we think the Fed's probably going to hike the funds rate quite a bit more than most think. We have 4 hikes this year, 4 hikes next year.
Also, I think the read between the lines there is don't get bogged down by political noise, at least for now. Jan, great to chat to you. Jan Hatzius there, the chief economist at Goldman Sachs. Vonnie, I will hand back to you.
Bloomberg's Julia Chatterley, she will be bringing us more from that conference. In fact, this hour, we'll have an interview with Charlie Himmelberg, co-head of Global Markets Research at Goldman Sachs, from that conference. It is time now to check in on the First Word News. Here's Taylor Riggs. Bonnie, South Korea's President Moon Jae-in wants to lower expectations for next month's summit with North Korea's Kim Jong-un. Moon says it's just a start and he can't be optimistic yet. The South Korean envoys who met with Kim will brief the Trump administration. U.S. officials are skeptical that Kim is serious about suspending his nuclear weapons program. The Trump administration has stepped up its war on illegal immigration. It sued California over 3 state laws that officials say interfere with federal immigration enforcement and violate the Constitution. The laws restrict state and local authorities from sharing information about undocumented immigrants with federal agencies. The porn star who was paid for her silence about an affair with Donald Trump has now sued the president. Stormy Daniels claims her non-disclosure agreement is not valid because President Trump failed to sign it. Daniels agreed to a $130,000 payout weeks before the election in exchange for her silence. And the European Union's draft guidelines for a trade deal with the UK fall short of what Prime Minister Theresa May is demanding. Bloomberg has seen the document, and it calls for a trade deal similar to the one with Canada. British banks would have limited access to the EU's single market. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Bonnie. Taylor, thank you for that. Well, still to come, I'm excited for this. The head of the international campaign to abolish nuclear weapons, you all know it as ICAN, out of Geneva. Well, it is run by Beatrice Finn, and she's going to be discussing investments fueling the nuclear arms race. That's coming up. This is Bloomberg.
Live from London, I'm Mark Barton.
And from New York, I'm Bonnie Quinn. This is Bloomberg Markets. Well, as we've been saying all morning, Gary Cohn is out as President Trump's chief economic advisor, perhaps losing the battle over steep tariffs on steel and aluminum. Cohn didn't mention that dispute in a statement handed out by the White House. According to people familiar with the matter, he quit hours after a confrontation with the president over the tariffs. And we just learned from Press Secretary Sarah Sanders that the president is on track to sign these tariffs by the end of the week. We're joined now by Michael McKee, Bloomberg's international economics and policy correspondent. And we even have an update just in the last few minutes from the president himself, Michael.
Yeah, it's a little bizarre. He tweeted out that he has asked China to provide a plan to reduce their trade deficit with the United States over the course of the year by $1 billion. Well, they have a $35 billion trade deficit with the United States right now, a month into the year. So I'm not really sure what he means by that.
And in fact, you brought along a chart which shows graphically how much the deficit has sort of narrowed with China anyway.
Yeah, the trade deficit with China widened last year, but this year so far, it's just under $36 billion. They are by far our biggest trade deficit partner, but reducing it by $1 billion would be a drop in the bucket. I mean, they could do that very easily, but whether they would, that's another question. I don't think they want to be told what to do.
Michael, who's favorite to replace Cohn?
Nobody really knows. The names that immediately came to mind are Peter Navarro and Larry Kudlow, both very conservative, but very different views on trade. Navarro, the chief nativist in the White House, the man who wants trade wars, especially against China. Kudlow, as conservative as he is, very, very much a free trader. So it could be either one of those, or it could be somebody that we don't have any idea, who that person might be. Generally, they've been heavy hitters from Wall Street, or someone with a lot of background in economics at the National Economic Council, Larry Summers under Barack Obama. So maybe he reaches beyond that small circle for somebody that would reassure Wall Street.
Mike, as we were saying yesterday, the EU is ready to retaliate. We heard from the Trade Commissioner, Cecilia Malmstrom earlier, and she said, I truly hope this won't happen. It seems unlikely it won't happen, doesn't it?
Well, at this point, yes. You sort of have to retaliate in these sorts of situations, but they'll do it under WTO rules. And what it means is they can retaliate up to the amount of money that, in theory, their economies are going to lose because of the steel and aluminum tariffs. For the European Union, the latest calculation from the Peterson Institute is about $2.2 billion. That's a very small amount overall for the U.S. economy, hardly noticeable, but it would hurt specific sectors, and they're obviously talking about things like bourbon from Kentucky and blue jeans
and peanut butter.
What they want to do is hit the economies of the districts represented by the congressional leaders who could put pressure on Trump.
Talk about surgical.
Not a massive thing for the U.S. economy, but surgically designed to create pain that would affect those leaders, and maybe they would go to the president and say, my district hates this.
There There are precedents, as there always are. Bush had a 30% tariff, I should say, imposed on steel. What happened then, Michael?
Well, what we saw then was a very small hit to GDP, and most studies who've looked at it suggest that we lost more jobs than we gained. Gained some in the steel industry, lost some in downstream industries that use steel. There's dispute about the numbers because there are different numbers produced by people who have different stakes in the thing. But overall, a wash for the economy, but no benefit to the economy. And that's the general view of economists to these tariffs, is that while we might gain a few steel jobs, we'll lose some downstream because our industries will be less competitive, and therefore the tariffs don't do anything. George Bush put these tariffs on under a different provision of trade law, but he ended up taking them off because they weren't doing any good and we were losing in the WTO.
And we should mention that today we got the trade deficit numbers. It happened to widen.
Wider, yes, wider than forecast. And you know, Donald Trump's problem is he's complaining about the trade deficits, but he's been president now for a little over a year, so he owns the issue. I mean, these are his trade deficits now, and so if he's going to do something about it, he's got to come up with a plan that would actually reduce them.
All right, Michael McKee, Bloomberg's international economics and policy correspondent. Thank you. And coming up later this hour, Peter Navarro, director of the Office of Trade and Manufacturing Policy, will join from the White House.
Yes, Bonnie, and still to come here on Bloomberg Markets, Nobel Peace Prize recipient Beatrice Finn. She's head of the international campaign to abolish nuclear weapons. She discusses what's driving the nuclear arms race. This is Bloomberg.
Let's take you to Capitol Hill now, where Senate lawmakers are resuming debate on the Dodd-Frank overhaul bill. Let's get to Kevin Cirilli.
Thank you. We're here with Congressman Lukemeyer of the House Financial Services Committee. Congressman, let's start with Dodd-Frank. You said earlier this week that the Senate bill could be improved in the House once it gets out of the upper chamber. How would you like to see it improved?
Well, first we got to see what comes out of the Senate. I know Chairman Hensling, who I think you'll have on later, is in negotiation with Senator Crapo with regards to perhaps a manager's amendment that would include a lot of the bills that we're working on in the House that could be incorporated, bills that we've had huge bipartisan votes on. You know, in the last several months, we've had about 90 bills that we've passed in the House that we've broken some of the big bills up into small pieces and passed those small pieces. And there's probably 25 or 30 of those that have got some really large bipartisan votes that I think could be added to the bill and not hurt it. So it is negotiation with Senator Crapo, and with the amendment process still going on in the Senate. We'll see what that bill looks like when it comes out of the Senate, and then we'll take we'll take a hard look at it and move from there.
Speaking of negotiations, trade talk heating up here in Washington. Gary Cohn out. Your reaction to that? Who would you like to see replace him? And what do you make of the president's proposal to raise tariffs on steel and aluminum industries?
Two-part question. Gary Cohn, I think, has done a fantastic job as the economic advisor for the president. He's really been on the job with regards to his relationships with Congress, with relationships to our leadership, to try and promote the president's economic policies. He was, was front and center with the tax cut bill. He's front and center with the health care bill that we were working on last summer. I think he's been a very trusted advisor to the president. Unfortunately, it seems he got crosswise with the president here with the tariffs, and they parted ways. But the president's done a good job of putting good people in the places around him. So I think whoever replaces Gary will do a fantastic job, and looking forward to see who that next person will be.
And your thoughts on the tariff debate?
Well, I think the key thing that I haven't seen anybody talk about yet is the fact that we've been in a trade war with China for a long, long time. So how do you solve that problem? They've been subsidizing industries, which is kind of reverse tariff, to undermine our industries here in this country. So it hurts our industries, it hurts the jobs that we have in this country, hurts our ability of our companies to be competitive. So how do you solve the problem? I think that the president is trying to figure this out. Is the tariff situation, what he's trying to put together right now, is that the solution? I don't know if that's the total answer. He seems to be indicating now that he's looking at other options, so we'll see how it develops.
Congressman, we've got under a minute left, but tell me about your bill that would, with data sharing, and how you would allow for companies to, once if they have a breach, to have to report it.
Well, we think the breach needs to be reported immediately as soon as they ascertain what kind of information was breached, whether it was a personal data that was breached, and have the okay from law enforcement. Law enforcement sometimes wants to try and find the bad guys who got in, and so we need to make sure they can do their job. But once they give the company the thumbs up, they need to immediately report that so people can do the best they can to protect their information.
Congressman Luke Kamar, do you want to be chairman of the Financial Services Committee?
It would be an honor to do that, but we got a lot of water under the bridge.
We'll leave it there. Toss it back to you in New York. Thank you.
Our thanks to Bloomberg's chief Washington correspondent Kevin Cirilli on the Hill there. Still ahead, the head of the international campaign to abolish nuclear weapons, ICAN, out of Geneva, Switzerland. The group run by Beatrice Finn, of course, won that Nobel Peace Prize last year. Finn will discuss the nuclear arms race, Iran, North Korea, and investments that are propping it up. Meantime, take a quick look at the stock market. We can see that stocks are lower today. The Dow is down 0.6% now. The S&P 500 down 0.4%. A few little jitters running through this market. This is Bloomberg. From Bloomberg World Headquarters in New York City, I'm Vonnie Quinn.
And live from Bloomberg's European headquarters here in London, I'm Mark Barton. This is Bloomberg Markets on Bloomberg Television. Check out what's happening to European stocks. It's been a choppy sort of day. Investors responding to the departure of Gary Cohn by sending the benchmark stock 600 lower at the start of the day, but it's retraced those losses and then some. It's up by about 1/5%. Gains here in London, gains in Germany as well. Vonnie, got some break-in oil inventory data.
Yes, Mark, a bigger build than we were looking for in the survey. 2.4 million barrels is the build there for crude oil inventories. That's 2 weeks of a build now. 3.01 last week, 2.4 this week. And of course, we can see that crude oil futures, which had been lower all morning, are down about 25 cents now at 62.33. A quick look as well at gasoline inventories. There was a drawdown there of 788,000 barrels. We were looking for a build there, so that is bullish gasoline prices. And refinery utilization, that improved ever so slightly by a fraction of 1%, 0.2%. All right, now we want to get back to the stories of the day, Cohn quitting and tariffs. Let's get back to Washington, D.C. Here to take us there is Bloomberg's David Weston, who joins with a special guest.
And we welcome now our audience from both Bloomberg TV and radio as we talk with Dr. Peter Navarro. He is the director of the White House Office of Trade and Manufacturing Policy. Dr. Navarro, welcome back to Bloomberg. Good to have you, sir.
David, my friend, it's been a while.
Yeah, it has been too long, exactly, sir. So there's been a fair amount of activity in your neck of the woods, I think it's fair to say, with Gary Cohn saying he's going to step away. I want to start there. The president's been very explicit that he wants different voices, even conflicting voices, really informing him about economic policy. As the president looks to replace Gary Cohn, should he be looking for someone with Gary's particular point of view, which sometimes, let's be frank, might not have agreed perfectly with your own?
The president tweeted out this morning that he's got a very long list of people he's going to interview. I think it's going to be a great list. I think the thing, first of all, look, we're going to miss Gary. Gary's a great colleague. Myself, I loved having discussions with him because we do have differing points of view, and the president loves that. But it's a deep bench here. I mean, with inside the perimeter, Kevin Hassett at the Council of Economic Advisors, just a superb economist. Mick Mulvaney at OMB. I mean, this guy is leading a deregulation revolution in this country that we haven't seen since the days of Reagan. You go outside the perimeter, you got Steve Mnuchin at Treasury, who did a heck of a job on the tax bill. Wilbur Ross is just doing all sorts of great things. So there's a deep bench here with a lot of differing points of view that come into the room. The president loves that. But here's the point. At the end of the day, I liken what goes on here, the football team like the New England Patriots, right? Like every year the Patriots win the division, but they do it with different players. What doesn't change is the coach and the quarterback, and that's what we have in Donald Trump. And he had the best first year on the economy of any modern president, and we're going to have a great second year. And if you look at all the leading economic indicators right now, everything's bullish, and I think if investors look at this market, I think they'd be bullish on this market.
I want to come exactly right back to that, Peter, but just before I do that, I want to follow up on one thing. You're too modest to say you're up for that job, but I'm going to ask you, if the president came to you and said, Peter Navarro, I need you to go into that job, what would your response be?
Well, of course, I'd be honored, but I'm not on that list. Let me be clear. And the president's going to have a very long list of people he's going to interview. I'm here to serve the president, no more, no less. I'm here to defend the working men and women of this country. And I've got a very full plate at the Office of Trade and Manufacturing Policy. In addition to doing a lot of stuff on trade, I do a tremendous amount on the defense industrial base. And I take those duties very, very seriously. I want to put men and women to work every day with their hands in manufacturing. that's what I'm focused on.
Okay, so let's go back to your day job, as it were, and let's talk about the president's pro-growth agenda.
It's more than that.
Day and night.
Too, yeah.
Fair enough. I'm sure that's right. So let's talk about the president's pro-growth agenda. You talked about that long before he became president, frankly. That's really where you thought we needed to go. But
you know, when the market was down, the futures were down the day after election, I got on a competing financial network, should we say, and I laid out what I'll lay out for you today. Basically, we got a 4-point program where we promised at the time tax cuts. We got those. We promised deregulation. We're getting that in spades. We're getting energy unleashed in this country. We're turning into the largest energy producer in the world. Check that box. And the president has been just amazing in the trade space. I mean, who would have thought when he got elected that we already would be renegotiating a better NAFTA for the American people? So if we hit all 4 points of this compass, we will have a tremendous spurt in growth, but we'll also have higher wages on higher productivity gains. So, look, people who watch your show, they're investors. What are they going to do today? Are they going to go long or short? This market, I mean, look, this is bullish. Every sign is pointing up. This is a great president and a great economy.
Yeah, no question the market has been up and investors have been very enthusiastic on the promise of growth, and particularly the tax cuts have really helped with that. But let me ask you very directly, are tariffs, like the tariffs on steel and aluminum, are those pro-growth for the economy overall?
Yes, sir, they are. And if you look simply at the experience last month of the solar tariffs and the washer tariffs, they were larger than the ones we're contemplating on aluminum and steel, 30% for solar, up to 50% for washers. What happened? This is the genius of Donald Trump. We had a flood of new investment in those industries, and the first time in 10 years, it looks like we're going to have a solar industry back. That's good for America. That's making America great again, and it's a good thing, sir.
So I want to remind everybody we're talking to both Bloomberg Television and radio. We're talking to Peter Navarro from the White House. So Peter, I guess my real question is, it's clearly good for the industries involved. It gets the prices up, as a practical matter, even though it may mean people may pay more for the goods. But is it good for the economy? I mean, you're a PhD economist. You study these things. Does it lead to the economy overall growing?
Sure, it does, because what we get when we defend an industry from unfair competition is what we get is more employment in that industry. We get higher wages. We get more tax base, and that's good. But let me be clear about the aluminum steel case, because it's a very special case. All we're trying to do with the steel and aluminum tariffs, which are very modest in terms of their levels, is to defend those industries. The president said very clearly that we can't have a country without a steel and aluminum industries, and I totally agree with him. And the aluminum industry in particular will go away in just a matter of a few years unless we take the actions that we're going to be taking. We lost 6 smelters since 2013. We only have 5 left. Only 2 of them are operating at full capacity, and only 1 of them makes the high purity aluminum we need for defense applications, and we import over 90% of our needs. This is an industry that needs our help. The president is there to help this industry for national security, for the men and women who work in an industry, and it's going to be a great thing for America.
Peter, there's a lot of back and forth right now in Washington about exactly what these orders will say, whether it'll be surgical, whether some things will be eliminated or not. When will we know the answer to that question? When will the actual language come out so we know what these orders will say?
You know, that's to be determined, but we're tracking very well for this week, and that's what the president has promised, and it's going to be a great day for America.
Okay, finally, Peter, trade wars. We hear an awful lot of talk right now in the media, let's be honest, about the possibility of trade wars. How concerned are you about, A, whether there will be trade wars, and if there are, what it really would do to that pro-growth agenda?
I can hear you, yes. So, look, the president has said this repeatedly, and let me echo what he said. We are the freest trader in the world, hands down. Low tariffs, low non-tariff barriers, and all we get for that is a $500 billion a year trade deficit that offshores our wealth, offshores our jobs. My own view is that all the countries now who trade with us are getting the better part of the deal, and therefore they have no incentive at all to get into any conflict with us. And I would hope that everyone, our allies in particular, would understand that if they want America to come to their defense, we won't be able to do that without an aluminum and steel industry.
Okay, Peter, thank you so very much for spending your time. I know you are a very busy man. That's Dr. Peter Navarro. He is Director of the Office of Trade and Manufacturing Policy at the White House.
And our thanks to Bloomberg's David Weston, speaking to noted economist as well there, Peter Navarro, author of The Coming China Wars, among many other books previous to his current role. We'll be back with another key member of the Trump administration later on. We'll speak with U.S. Treasury Secretary Steve Mnuchin. That's going to be after the closing bell.
Lonnie's still ahead here on Bloomberg Markets. They're ahead of the international campaign to abolish nuclear weapons. The group run by Beatrice Finn won the Nobel Peace Prize. She'll discuss investments fueling the nuclear arms race. This is Bloomberg. Live from London, I'm Mark Parson.
And in New York, I'm Vonnie Quinn. This is Bloomberg Markets. North Korea has told South Korea it's willing to give up its nuclear weapons. This would open the door potentially for talks between North Korea and the United States. But many, including South Korea's president, are skeptical about the North Korea leader's pledge. All this, of course, coinciding with a report out today highlighting the top 20 companies set to benefit from a nuclear arms race. Joining us with more, the woman behind that report, Beatrice Finn. She is the executive director of ICAN, which is the International Campaign to Abolish Nuclear Weapons, and Nobel Peace Prize winner. ICAN won the Peace Prize in 2017, so congratulations.
Thank you very much.
Tell us a little bit about this report. What exactly does it say?
Well, the Don't Bank on the Bomb report was launched today, and it shows that the companies that are profiting from this incredible, huge threat to international peace and security that we're seeing right now, with Trump and Putin and Kim Jong-un threatening to use nuclear weapons. There are companies behind that are profiting, building these weapons, like Honeywell, Boeing, Airbus, for example. And there's a lot of banks and financial institutions that are lending them money to do this.
So this is capitalism. What good does it do to point this out? You could say it's up to governments to maintain peace. These companies need to be in the business of defense. Are they doing something wrong?
Well, these weapons do not maintain peace. They threaten to kill us all. These are weapons of mass destruction, inhumane, indiscriminate. And today, it's not just good enough for financial institutions to just go for profit. They also have a responsibility. Just like with climate change, this is not a threat that we can ignore forever, because nuclear weapons will be used if we keep them forever.
And we actually have a chart there on the companies that are investing the most in nuclear weapons producing companies. Should these companies withdraw their money because a tiny part of some of the companies they invest in is investing in nuclear weapons?
Yes, these are banking on Armageddon, profiting from chaos. And this is a very small part of these companies' portfolios. And they can pull that out and make a real contribution to a more sustainable world.
And Beatrice, how do you pressure these companies? As you state in your report, just nine countries have nuclear weapons, and compelling change from these 9 countries will take a variety of approaches. What are those approaches?
Well, looking at the private sector, for example, that have a lot of influence of this. As I said, these companies, their nuclear weapons production is a very small part of their portfolio. And therefore, by making it available to consumers, most people don't know that when they get on a Boeing plane, that Boeing also produce nuclear weapons. Or when they buy things from Honeywell, that they also contribute to a nuclear arms race. And by making this report available, we can put pressure, and consumers are interested today in knowing what the companies and what their money goes to.
Be a little bit more specific, though, Beatrice, because, you know, there are certain things that if they're put together, they're a nuclear weapon, but if they're not put together, they're perfectly harmless individual pieces of metal or whatever it may be. So why do these companies need to be concerned with what's done with their materials after the fact?
Well, these have contracts with the governments that have nuclear weapons and are directly producing the missiles and the equipment for nuclear weapons. So it's directly contributing to the ability to have weapons of mass destruction.
Beatrice, you haven't just got this hall of shame, you do actually have a hall of fame as well. Tell us about these financial institutions that have comprehensive policies preventing investments in nuclear weapons producers.
A lot of companies today are taking their responsibility on this issue. And we see a drop of 10% of the investors that have removed investment from these producers because of this. And for example, 2 out of the 5 biggest pension funds in the world have instituted policies and removed their weapons. And I think that's a really responsible way for these financial actors to act. And that's a direct response to this new treaty on the prohibition of nuclear weapons. Weapons that are illegal are bad for business.
Well, and we're seeing this in so many different areas now, you know, that it's up to the private sector sometimes to make a difference as opposed to the publics or the so-called elites. Talk to us about the current arms race, North Korea, South Korea, the overture from the North Korea leader to South Korea, which might open the door to the US, but it's all very iffy. What do you see happening there?
Well, we saw some positive signals yesterday, and I think it's now up to all states involved in this conflict to really carefully use this moment and start the diplomatic process. But at the same time, it's really terrifying that we have to push nuclear weapon threats so far that we're on the brink of nuclear war before we can get to a solution. One day we will take a step too far, and the nuclear weapons will have to actually go off. Not just intentionally, perhaps, by a leader that presses the button, but an accident or a mistake.
What's the best way to pressure governments or to pressure? I mean, is there a blueprint? Because all governments are so different. Look at Iran, look at the US, North Korea. You couldn't get 3 more different regimes or administrations in some ways. Is there a blueprint?
There is. We have seen all the other weapons, biological weapons, chemical weapons, landmines, cluster munitions, that treaty-based prohibition is the first step to eliminating these weapons. And that prohibition will be a mobilizer for governments to take action, for civil society, for the private sector. We've seen huge divestment campaigns from cluster munitions and landmines, for example. And together, all of this pressure from different angles, based on this new norm that the weapon is illegal, can make a difference. We've seen last year the treaty on the prohibition of nuclear weapons was negotiated, and states are starting to join this. And slowly we can build enough pressure on all these governments to get rid of these weapons.
At a time when certain countries are moving away from multilateral agreements, and certain countries never even contributed to multilateral agreements in certain areas, you know, international courts of justice and so forth, how do you get a country that just doesn't want to be part of a group like that to also have a conscience when it comes to nuclear weapons and you know, have a responsible policy on them?
I think all governments in all countries in the world have to relate to international law and international norms. They might not admit it straightforwardly, but it matters to them what international law says. And we've seen that even the most reluctant countries get dragged along. It doesn't go as fast, of course, with some countries. Some are in the front line, some are a little bit slower, but we are dragging them in the right direction. And it's also up to the people of these countries to take action. And this is a perfect example. We can look at where our money are. What does my bank do? Is my money contributing to this arms race?
Very briefly, have you had any responses from any of these companies?
We have, actually. We're in conversations. I've been meeting with banks here in New York. We've seen some responses, which shows that it's a sensitive issue to them. They do not like to be called out on, producing nuclear weapons. They like to keep it hidden. So we're really looking forward to engaging with the private sector on this issue.
All right. A phenomenal woman. Our thanks to Beatrice Finn, who is Executive Director of the International Campaign to Abolish Nuclear Weapons, also known as ICAN in Geneva. And Mark, you could say she kicks off her International Women's Day coverage as well. We didn't talk about it, but of course she's a phenomenally accomplished woman.
Yes, that, of course, is tomorrow, Vonnie. Got some breaking news, Vonnie. Setting shares in Renault higher by 12%, biggest increase since 2009. Nissan's in talks to buy the French government's 15% stake in Renault. That's according to a report from Reuters. Renault shares, as I said, rallying on the news. Renault holds a 43% stake in Nissan. The French state holds a 15% stake in Renault. The car makers are said to be in talks with government officials. Renault-Nissan head Carlos Ghosn is seeking for France to give up influence at Renault and for Renault to give up control over Nissan. Shares of Renault surging on that breaking story. We'll keep up to date on that. This is Bloomberg.
Let's return now to the Goldman Sachs Annual Housing and Consumer Finance Conference. It's underway here in New York. Bloomberg's Julia Chatterley is back with another guest. Julia.
Thanks so much, Vonnie. We're joined by Charlie Himmelberg. He's the co-head of global market research at Goldman Sachs. Great to have you with us. We were just listening to Peter Navarro, economic advisor to the president, obviously in light of the news cycle in the last 24 hours and Gary Cohn's exit. Two conflicting voices in the White House. Tough to see where economic policy goes now.
Yeah, I mean, I think it was, markets took a lot of comfort in the fact that Gary Cohn was there, and they viewed him as a voice for the markets and kind of a balancing force against the tariff contingency within the White House. So I think markets will look for ways to worry about this.
Are you worried about a trade war ultimately here?
Not really. It still seems like a pretty tail risk to us, but that said, once you've started the ball rolling, it's hard to know how far it rolls.
It feeds into a narrative, though, and a nervousness that the markets feel right now. You obviously have done a great deal of work on volatility, the greater moderation, as you call it, the suppression of macro-level volatility. Where are we right now?
Yeah, well, the point of the greater moderation observation is just to say that if you look at the macro data itself, whether it's the volatility of employment, GDP, inflation, there really hasn't been any drama in the data. The drama really has been in the markets. So I'm thinking of, for example, the VIX spike earlier in February, as well as, the latest news out of DC. So I think the catalyst or the drama really is coming from places other than the macro data at the moment.
You describe yourself as reluctantly bullish on equities at this moment, based on valuations relative to where rates are particularly.
Yeah, I think, the reluctance comes from the fact that valuations are high, and everybody knows that.
Yes.
But the reason you have to go there anyway is because if you look at those macro fundamentals, the volatility is not there. It looks like we're on pace for a very strong year of growth in 2018, both from the U.S. and globally. So it's hard to see what derails markets in that environment.
What does?
Well, it could be some of the things we've seen already, right? I think, one of my big concerns around something like the VIX crash, which I would argue is the sort of thing we've seen now in lots of major markets, right? We've seen flash crashes in rates, in equities, now in VIX, we've seen them in FX. So I think as long as those flash crashes are happening at a time when the macro backdrop is solid and sound, markets don't worry about it. But the question that hasn't been answered, right, and is not tested is what happens if we get a flash crash at a time when the market is already worrying about the macro environment.
You also point out quantitative tightening, and we're talking about potentially the ECB and Japan here, and investors are already nervous. We've seen that this year, kind of irrespective of the macro data where core inflation is pretty anchored in those regions. What about this?
Yeah, I mean, I think it's another example of market psychology, right? I don't get worried about QT from a fundamental perspective. It's not even a tightening, right? Globally, it's just a deceleration of the pace of asset accumulation by central banks. Having said that, in our conference this morning, we took a poll in the room and I asked for a show of hands. How many people in here think QE is the main reason asset prices have rallied as much as they have in this expansion? And almost every hand goes up. So it's a pillar of belief in the market that QE was a big deal. So I think the withdrawal of QE is kind of like taking away the security blanket. It's not quite clear how that will go psychologically, but so far I think central banks have managed that communication pretty successfully.
Brilliant. Charlie Himmelberg, co-head of Global Market Research at Goldman Sachs. Mark, I'll hand back to you.
Julia, great chat. Thanks for joining us. Julia Chatterley there. Coming up on the European close, we're following stocks. We're less than 35 minutes until the end of today's session. Have a look at what's happening. Stocks rebounding from earlier lows. FTSE, DAX, CAC all up by a minimum of 1/3 of 1%. Look at the currency board. How's the euro faring ahead of that big ECB meeting tomorrow? Euro is little changed against the dollar. Sterling's up by about 1/20 of 1%. I'll leave you with the bond board. The close is in 33 minutes. This is Bloomberg. It's 11 o'clock in New York, 4 p.m. in London, midnight in Hong Kong. There's 30 minutes left in the trading day in Europe today. From Bloomberg's European headquarters, I'm Mark Bartlett.
And in New York, I'm Bonnie Quinn. This is the European close on Bloomberg Markets.
Here are the top stories we're covering from the Bloomberg and around the world. Markets rattled. Gary Cohn leaves the White House following a showdown over tariffs. We'll look at what kind of policies his replacement is likely to push for. We're going to get insight on the markets. Nigel Wilson, Chief Executive of the UK financial giant Legal & General. Their stock is up today on an earnings beat, record earnings last year as well. And the reform program of Saudi Arabia's Mohammed bin Salman will be under the microscope today. He faces his first test abroad. He visits London. We are live from Downing Street. Have a look at what's happening to European equities today. They've rebounded. They fell earlier on the news that Gary Cohn was leaving. They've rebounded. Italy, FTSE MIB up by 1.4%. Election? What election? Seems like a long time ago. These currencies are moving against the dollar. Euro barely changed ahead of the ECB tomorrow. Sterling barely changed. Some big Brexit happenings today. Bond yields falling. Commodities, CDS is your final two columns on our wonderful GMM function. House prices here in the UK, the slowdown continues. Prices growing at the slowest rate in 4 years. The annual rate of change in the 3 months through February slowed to 1.8%. That's the least since March 2013. In the month, values rose by 0.4% after a revised 0.5% drop in January. Housing markets cooled in the last year. London's been a particular weak spot. Growth lost momentum. Consumers facing a squeeze on their incomes after Brexit. We had that report from Nationwide Building Society last week showing that Brexit and the weaker economic outlook are reinforcing that slowdown in 2018. Let's move it on. Some quant investors are concerned that the most popular trend-following commodity trading advisors, CTAs, are ill-equipped to handle this new era of steeper declines, sudden volatility spikes. The strategy which rides out price trends across asset classes fell 6.4% in February. That's what this chart shows us right here. That's the worst month since 2001, according to a SocGen basket of the largest 20 managers. CTA funds fell by 0.7% in the first 3 trading days of March. Many programs were built on data from 9 years of relative market calm, and of course that's all breaking down. So says Quest Partners. Wonderful chart. Let's finish with this. Hang Seng Seng volatility. We had the Hang Seng, the benchmark in Hong Kong, fall by 1% today, buffeted by concerns over this possible trade war. We had a rebound of 2.1% yesterday. We had a decline of 2.3% on Monday. The last time measures had back-to-back moves of over 2% was in January 2016. The risk of a global trade conflict is coinciding with the annual NPC, and a gauge of 50-day volatility on the Hang Seng, which is what this is, has climbed to its highest level since April 2016. Keep an eye on what's happening in China. Keep an eye on what's happening in Hong Kong. 90 minutes into the session in the US. Julie, how's it looking over there?
So, Mark, we've seen a similar pattern here in the markets. That is a little bit of a rebound, or at least a pairing of declines for the major averages. The NASDAQ has now turned into the green. Semiconductors continue to be strong on a relative basis today, with the SOX, the Philadelphia Semiconductor Index, still trading at a record. But a lot of the talk, of course, is still about Gary Cohn and about trade. We happen to get the most recent trade deficit numbers today, and you can see them if you take a look at the Bloomberg here. The gap going to up 5% to $56.6 billion. This was in January, and that was a widening of more than forecast. So now it's the biggest trade deficit going back to 2008. The overall trade deficit last year, by the way, was $566 billion. So we await news on who could replace Gary Cohn. Peter Navarro telling Bloomberg Television he's not on the long list of candidates to replace Cohn. He is seen as one of the more nationalist or protectionist candidates that had been at least talked about. So interesting that he made that comment to Bloomberg Television. If you look at steel and aluminum stocks today, we are seeing strength there, as you might expect, as Cohn's departure is seen as perhaps cementing the idea that the president's going to go ahead with the tariffs. U.S. Steel, AK Steel, Alcoa, and Century Aluminum are all on the rise. And then finally, I also want to talk about retail. That's an area of weakness today, particularly when you look at the dollar stores, the discount retailers. Dollar Tree's fourth quarter earnings per share missing estimates, its first quarter forecast missing estimates, and comparable sales trailing estimates as well. There are some analysts who are coming out and saying buy on weakness, among them the folks at Guggenheim. The analyst there says that the earnings per share forecast missed, but it does reflect a greater than expected tax reform reinvestment that could eventually be positive for the business. Not so positive, though, for those shares today, Mark.
Julie, great stuff. Now, the ECB is expected to hold interest rates steady tomorrow. Markets watching the bank's decision for clues about the wind down in QE or potential rate hikes. What signals are equity strategists, fund managers looking for? Let's bring in Stephen Macklow-Smith, head of European Equity Strategy at JP Morgan Asset Management. Hi, Stephen. If there was to be a surprise, if there is to be a surprise tomorrow, where might that surprise come from?
Well, I think the first thing to say is that we're not expecting a surprise, like most people. I guess people might be looking for some indication on how they wind back the QE program, and also looking for some indication on how long rates will stay low. So as ever, people are going to be combing through the text for any significant words or phrases that they can.
Monitoring exchange rate volatility was in last month. The euro's come down since. Are European companies weathering the euro, we'll call it the euro storm, or not?
Well, look, I mean, there are very few companies that manufacture wholly in euros and then export to other countries. Broadly speaking, people balance their manufacture and sales, so there's a translation effect on earnings, and people have been a little bit concerned about that. And I think it was interesting that the fourth quarter earnings season, while it was a beat, didn't actually lead to net earnings upgrades for Europe, so suggesting that currency strength has held back or tempered the enthusiasm of corporate management just a little bit. But I think, overall, as long as the exchange rate appreciates steadily and slowly, then it's not that much of a concern for most European companies. The other point about exchange rate appreciation, of course, is that it bears down on inflation. So there is a kind of an inflation pass-through effect, which the ECB, they will be sensitive to that.
Right. So what is your prognostication for the European economy, Stephen, and for the ECB?
Vonnie, we think that the European economy continues to grow slightly above trend. I think the pace of growth may decelerate a little bit in the first half of this year. But, we don't see any reason to suppose that there is anything sinister out there about that rate of deceleration. I think there has been some inventory building that's gone on, and that may come back a little bit. But if you think about the building blocks of the economy, from a government expenditure point of view, that's sort of modestly positive. Consumption looks positive. Unemployment coming down, real incomes are rising, capex is rising, corporate confidence appears to be good, and as long as the growth rates of the rest of the world remain strong, then there's going to be an export tailwind to European growth as well. So I think the picture is broadly constructive, and it underpins an expectation we have that earnings will grow by 10% this year.
Is there a dichotomy between Northern Europe and Southern Europe, for example? We've heard that in the past few days. And what about Britain? Can it be considered part of that universe anymore?
Well, absolutely, because the European Union remains the UK's single largest trading partner, and in a way, from one point of view, since the Euro referendum, nothing has changed, because the UK remains a part of the European Union with all of the trading privileges that entails, but it benefits from a depreciation in sterling against the euro, which has made it more competitive. To your first point about a distinction between Northern Europe and Southern Europe, I think it's the heat map of growth across Europe is looking reasonably solid. In Italy, the rate of growth is accelerating, but it's still nothing that you would actually call mind-boggling, or it's nothing to really stand out against the crowd. But in Spain, for instance, the rate of growth since they carried out their reforms has been extremely solid, and growth looks pretty broadly based across the board. As I said, the building blocks look in place.
Stephen, let's talk trade. A Bloomberg story came out during our show, but I managed to read through it. European Stock Investors' Guide to Trading in a Trade War. And it breaks, Ksenia Galuchka, who's often our guest, she breaks it down into steel, aluminium. And actually, she says, it's not that big an impact if these tariffs go ahead. Autos will be affected more. They've got that natural hedge, though, of producing cars in the United States. Are you considering positions in these industries given the onset of a potential trade war? And are there industries which Ksenia says there are, which could be shielded from a trade war, such as chemicals, healthcare, telecoms, and utilities? Yeah, what's the Macklow-Smith view? Well,
we're not second-guessing the outcome of any positioning that's taken by politicians. Although tariffs have been announced, we're not clear that they will actually be imposed or what the timescale for that is, and we're not sure what any retaliatory measures that are taken might be. So we're just going to hang fire. I mean, broadly speaking, I think at the moment it's more important that economic growth has been accelerating, because if you think about that earnings dynamic I was talking about earlier, a lot of the best earnings growth is coming in the financial and cyclical area of the market. Now, if growth decelerates, that might change a little bit. But I think that there's another issue out there which the market is going to have to face up to at some point, and that is that a lot of the momentum trades that have driven performance for the last 18 months have been driven by a weakening of the dollar. And, leaving trade wars on one side for a minute, I'm quite interested by what's going to happen to the dollar over the balance of the year, because if it continues to weaken, then we would expect that you would see higher inflation, better performance for financials and cyclicals. But if there's a turn in the dollar, then you might have to see portfolio managers repositioning. So within our portfolios at the moment, we're sensitive to the threat of a change in direction in the dollar, and keen to ensure that it's not our single largest active position.
Stephen, great to see you. Thanks for joining us. Stephen Macklow-Smith, Head of European Equity Strategy at JP Morgan Asset Management. Vonnie.
Mark, let's check in now on the Bloomberg First Word News. Courtney Donahoe has that. Courtney.
Hey there, Vonnie. The Trump administration is now setting its sights on Chinese imports and investments in the U.S. According to people familiar with the matter, the U.S. may clamp down on both to punish Beijing for alleged theft of intellectual property. Penalties may include tariffs on Chinese products and limits on the country's investments in the U.S. South Korea's President Moon Jae-in wants to lower expectations for next month's summit with North Korea's Kim Jong-un. Now, Moon says it's just a start and he can't be optimistic yet. The South Korean envoys who met with Kim will brief the Trump administration. U.S. officials are skeptical that Kim is serious about suspending his nuclear weapons program. British officials say that they will respond to evidence and not rumors in the mysterious illness of former Russian spy Sergei Skripal and his daughter. The two were found slumped on a public bench, and there is speculation that Russia is involved. But Home Secretary Amber Rudd says, quote, "We need to keep a cool head." Skripal was convicted in 2006 of spying for the UK, but later released. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Courtney Donahoe. This is Bloomberg. Bonnie.
Courtney, thank you. Coming up, President Trump's top economic advisor, Gary Cohn, makes his exit after a showdown on tariffs. We're live in Washington, D.C. to discuss what's next for the White House and the global economy. This is Bloomberg.
Live from London, I'm Mark Barton with the European close roughly 15 minutes away.
And in New York, I'm Vonnie Quinn. Gary Cohn's departure from the White House is raising serious questions about the future of the administration's economic team. This as Press Secretary Sarah Sanders announced that the president is on track to sign his tariff plan by the end of the week. We're joined now by Margaret Talev, Bloomberg's senior White House correspondent. First of all, Margaret, just sum up the reactions, I suppose, in the water cooler talk in Washington, D.C. today following Cohn's departure. Is it as major a deal as some of the other high-profile departures in recent days?
It is a very big deal because Gary Cohn was part of what was considered sort of a moderating influence on the president. You can call it the globalist wing if you want to. You can call it the moderating wing. But in either case, he was certainly a counterpoint to the kind of Peter Navarro, Wilbur Ross, Stephen Miller block that's now emboldened just inherently with that vacuum that is expected to come in the coming weeks. We've seen some initial reaction market-wise, but I think folks are waiting for two things to happen. Number one, to see what the tariff plan is that the president actually rolls out tomorrow or Friday, and to find out who will replace Gary Cohn. Both really important questions. On the one hand, Gary Cohn's departure had been long awaited. You'll remember after the Charlottesville controversy of last summer, some thought he would leave. Then after the most recent controversies involving sort of somewhere between the Fire and Fury and the Rob Porter controversy, Again, the thought that Gary Cohn would leave. This time it's actually happening. So everyone's had a while to prepare for it. And at the same time, because it's the Trump administration, everybody thought, well, is he really going to leave? If he stuck it out this long, maybe he's in it for the long haul. This is now a turning point.
It also appears that there's a slight shift in the winds when it comes to these tariffs in the last 24 hours, with Wilbur Ross saying there might be some carve-outs or country exemptions. And now, just in the last few minutes, we have word from the Energy Secretary, Rick Perry, who's at CERAWeek in Houston, and he's saying that he's not sure that Trump has made his mind up on tariffs. So clearly there isn't complete agreement.
Yeah, that's a really important thing to point out because Rick Perry is not speaking out on his own or sort of making it up. He is his remarks are calculated and vetted, and he's raising questions about the implications on pipelines. One of Gary Cohn's last kind of official acts before his plans to resign became public and were announced was that he was scrambling to put together this meeting of sort of end user executives, be it auto manufacturers, can manufacturers, the beer industry, and the oil sector, to come to a meeting with the president, which was supposed to happen tomorrow. Obviously, the schedule has all changed now, and basically try to educate the president about some of the implications that might be less obvious if he went forward with the 25%, 10% plan as originally proposed. Given everything that's happened, that meeting has changed a little bit. The vice president will sit in on it, and the president may well announce his plan before the meeting. It's not yet clear, but the point is that there are a lot of last-minute scrambling between Gary Cohn's move, the intense pressure from the Hill, and the pressure directly from CEOs that the president listens to. There is a real push also on the foreign policy front with the National Security Advisor and many of the diplomatic channels from key Western allies, a real push to get the president, if not to scrap his plans, then to certainly retool with a much greater emphasis on China and many more relaxations when it comes to the EU and to key Western partners.
Right, Margaret. So we have this threat of a trade war. We're not even quite sure what the president is going to do this week regarding tariffs. We also have the revolving door White House. We have the Kellyanne Conway saga. We have, you know, the Mueller investigation, which keeps getting more and more interesting. And then Mohammed bin Salman is actually at the White House today. What happens on the foreign policy front in the next 5 to 7 days, given that we got that huge North Korean news too?
Yeah, there is a lot going on with foreign policy, and the things to watch right now are exactly what's happening on North Korea in terms of the North Korean efforts to get the U.S. into talks with the floated promise of some sort of commitment to possible denuclearization. There's that. There's what's going on with Russia, both on the sanctions front, look forward to that, and on the elections front. And you've got all the Middle East politics coming to a head between Bibi Netanyahu's visit and a real effort to get Gulf leaders here in the next couple of weeks. The French visit in April, a lot going on the foreign policy front, very little room for chaos on the domestic side.
Our thanks to Margaret Talla, Bloomberg's senior White House correspondent. Mark.
Bonnie, great chat. Still ahead here on The Close. Saudi's Crown Prince arrives in London for a 3-day visit with the UK leadership. We're going to bring you the latest on this visit. That's next. This is Bloomberg.
Live from New York City, I'm Vonnie Quinn.
And live from London, I'm Mark Barton with the European close roughly 7 minutes away. Now, Prime Minister Theresa May has rolled out the red carpet for Saudi Crown Prince Mohammed bin Salman. He's just arrived on a 3-day visit to London. May said she will raise concerns in private about the war in Yemen, but UK Shadow Foreign Secretary Emily Thornberry says that isn't enough.
They're important friends, but friends should speak the truth to each other, and we should certainly be speaking the truth in relation to Yemen, but we also need to see this in the round. You know, all new leaders of Saudi Arabia we are told are reformers, and of course we should be pleased that at some time in the future women will be allowed to drive in Saudi Arabia. They're allowed to drive in the rest of the world, but there are a number of other things that need to be considered as well. For example, what about the Saudi Arabians' funding of jihadi groups in Syria?
Joining us with more, Bloomberg's Anne-Marie Horden. Anne-Marie, can Mohammed bin Salman put those controversies in Yemen, in Qatar, in Lebanon to one side and prove to be a reliable partner for the UK?
Good afternoon, Mark. Well, he's certainly going to try to as he sits down with Theresa May. I mean, for him, this is really so much of a business trip as the Saudi Crown Prince Mohammed bin Salman looks to his vision of 2030 to diversify beyond oil and expand the economy. Already, they're looking to try to bring more foreign investors into the stock market. Just 4% of foreigners invest in the local Saudi stock exchange. And of course, he's trying to drum up support ahead of the IPO, a partial IPO of their crown jewel. But I don't know if you can hear them now, but there are protesters outside the gates that, you know, they're upset with his visit here in London. All throughout London, Mark, I'm not sure if you saw, but I landed from Heathrow yesterday, and the entire motorway in was billboards about the prince. So really a red carpet for him here, and they're really getting this PR agenda out that Saudi is open for business relations and political ties. But it'll be interesting to see how May draws that line between what citizens are protesting, saying that the government is too repressive, and the fact that she certainly wants the IPO of Aramco to come here and to continue these business deals and trade deals, especially in the arms sector, Mark.
Yeah, a lot of it is the narrative, isn't it, Anne-Marie? It's explaining the narrative to a non-Saudi audience, explaining what he's doing to his economy, explaining how he's trying to open it up, how he's trying to improve women's rights. What sort of job's he doing on that front?
Well, this year, women will be allowed to drive in Saudi Arabia. On top of that, women and men can now go to football matches together, soccer matches for you, Vonnie, in the U.S. Cinemas are being opened in Saudi Arabia. So in terms of the youth in Saudi Arabia, many see him, as a leader, and he's not tied as much to the elite. We did have that huge purge in Saudi Arabia, Mark. So many are thinking he is opening up at the kingdom. This is his first visit. He's going to London, he's going to the West, then he's going to New York, he's going to Silicon Valley, Mark, interested in the tech industry. So that's really his message, Mark.
Anne-Marie, great job. We'll see you soon. Anne-Marie outside Downing Street today for the visit of Mohammed bin Salman. Take a look at where European markets are trading. We're heading to the close. It's been a bounce back. Stocks rising after falling earlier in the session. This is Bloomberg. From Bloomberg European headquarters in London, I'm Mark Barton. Check out what happened at the end of the Wednesday session. Stocks finishing higher. They opened lower, but they ended up finishing up for the third consecutive day. Best run since mid-February. The early concerns were over the resignation of Gary Cohn, the chief economic advisor, the White House economic advisor. Investors mulling the implications of stronger influence for protectionists in the Trump administration. But those concerns waning, and as you can see, stocks rising across the region. WMGO is the wonderful function for that chart if you have a Bloomberg terminal. Rolls-Royce, the big mover today in European equities. Look at that move, up by 11% today. Shares earlier jumping as much as 15%. Biggest increase since 2004. The aero engine giant pledging to deepen restructuring efforts after Chief Executive Warren East's initial cost cuts helped it to overcome years of earnings declines. He's eliminated about 800 management posts in an earlier slimming down of the unwieldy structure, and as well as more than 4,000 at the Marine unit. 11.3% was the rise in Rolls-Royce shares on this Wednesday session. I want to talk about Italy. It seems like a long time ago, doesn't it now, the election over the weekend. Bonds are back to levels before the election. Investors betting the country will muddle through the disputes of its political leaders. A broad coalition is likely to emerge in the end, and the country's economic data is still positive. So says UBS's wealth management division, which has maintained a neutral stance on local assets after Sunday's vote. Few investors want to short Italian bonds given the risks are seen as too long-term, so says Societe Generale. This is the difference in yield between the German and the Italian 10-year, and ahead of the ECB meeting tomorrow. Thought we'd have a quick peek at the euro. Little changed against the dollar. It's down 0.1%. Earlier was rising for a fifth-day best run since February the 15th. It snapped a 3-month rally in February. Probably means economists say the ECB won't allude to the currency's strength when it meets tomorrow. That's all to look forward to in the next 24 hours. That's a look at European markets.
Well, and isn't it fascinating that just at the weekend, Italy's election was the biggest thing we were looking forward to on Monday, and that's all changed. We've sort of gone back to sleep a little bit in terms of Italy, although some assets there are doing quite well. Here in the United States, the dollar index is staying soft. It did have that little period back above 90, but we're at 89.76 once again. The Canadian dollar inching ever so slowly towards 130. It is weaker by another 0.9%. Canadian economy obviously has something to do with this, but maybe more to the point is these NAFTA renegotiations and this talk of a trade war, which Canada may or may not be exempt from should there be tariffs imposed on steel and on aluminum. Crude oil futures are down 0.9%. We got a bigger build earlier in crude oil inventories. The barrel is trading at 62.01, and the 10-year yield, which we haven't looked at in some time, is crawling back up 2.88% today. Quick look at GMM. I want to point out Australia as well, which had a little bit of data that was disappointing overnight. Obviously, the RBA held this week, held interest rates steady. We're seeing the ASX 200 down 1%, and the currency is also on the decline, down 0.4%. South African rand also down 1% as investors size up this new administration in South Africa. And of course, the commodities are having a day in the red as well. No need to explain why that one is, Mark.
Bonnie, great stuff. LNG Group posting yearly earnings today. Growth of more than 25% in EPS. Earnings before interest and taxes flying past estimates. Here to mull over last year. Look ahead to the year that is. Nigel Wilson, LNG Chief Executive, with a big smile on his face. I'm sure you've had a long day, Nigel. Good to see you in the afternoon. Back in the day, we used to do the early show, the early interview. This is a bit easier. Record year last year. More of the same in 2018?
More of the same in 2018. Yes. We've got tremendous momentum in the business. It was really pleasing to have 32% growth in operating profit and pre-tax profit to 2.1 billion, but we're very confident about 2018 and beyond. We've got tremendous growth opportunities both in the UK and indeed in the US, and the US was a great market for us in 2017.
Is there an opportunity for a special dividend next year? I know, got to get the D question in there early.
That's up to my board, what they want to do. Clearly, our financial performance is ahead of even my expectations at the moment, and I'm hoping.
Can you give investors some hope? On that?
No, I think everything we do is very measured. We're sort of slightly anal in the amount of analytics we do, but we execute incredibly well, and strategy is really all about execution. We can have great ideas, but you've got to execute them well, and we're executing incredibly well at the moment.
It's a rising rate environment. Some say it is. How does that affect you?
No, that's good for us. I mean, it's very good for, traditionally very good for businesses like ours, a rising rate environment. And we see rates rising pretty much everywhere the next year and beyond. And that's good for many of our different divisions. But all of our divisions are firing pretty well at the moment. So I'm, for the first time since I've been there, I'm very happy about the performance of all divisions.
Will your pension business be able to return some more money, Nigel, at some point?
Will our pensions business be able to
return some more money?
I think we're very happy with the pension business on both sides of the Atlantic. We've now got 350 pension clients in the United States and over 3,200 in total. The world's getting older, people need to save more for their retirements, and they need more innovative products when they retire. All these trends are incredibly good for our business. That's why we're seeing such strong revenue growth and strong earnings growth everywhere.
How are you dealing with the challenges of what some are calling over-regulation, Solvency II? Those capital charges are definitely penalising you in some areas. What about the amount of risk you'll take given that you have to comply with these?
No, I think the regulator has been overzealous in certain areas, and both myself and the regulator appeared in front of the Treasury Select Committee last year. I think we've come to an amicable way forward, which is a balance between the regulator's position and our position. I'm sure the regulator won't go as far as we want them to, but they'll recognise that certain areas it needs to change. And the risk margin has been excessively onerous in the UK. There's recognition that it needs sorting out, and a very high degree of confidence that our regulator won't do everything that we want, but will do the right thing for the business, the industry, and indeed for our economy.
Mortality reserves, that's a big theme today, isn't it? You've released more money, you say more's to come. Longevity is an interesting topic, because you're saying people aren't living as long, and many looking to medical advances to prolong our lives. We had a fund manager on Bloomberg not so long ago saying life insurers are toast in the long term. I won't say who it was. Longevity versus mortality reserves discussed, and the impact on you.
Yeah, and I think what we're finding is the trend has not been as pronounced in recent years. People aren't living as long as our assumptions. So we're seeing that both in the UK and indeed in the United States, probably more pronounced in the United States than it is in the UK. There's lots of reasons for that, and we don't need to go through them all in the air, but it's resulting in us having what were prudent reserves becoming excessively prudent reserves. And for this year, next year, the year after, and the year after that, we can see a steady progression of releases of those reserves, which we turn into cash for shareholders.
And those trends in longevity could drive a bumpy year in annuity and closed book deals, which leads to the obvious question, Prudential's back book.
No, I think what we've seen... Are
you going to land the really big fish or not?
No, I think we look at all back books, and we've done 2 deals in back books over the last few years, but we've got much more customer business than we've ever experienced in the history of the company, both in the UK and indeed in the United States. And kind of customers come first before back books, but of course we look at all of the back books as well. But there's a steady progression of business. You know, there's only 4 or 5% of all of the liabilities in this sector. And in the US, it's 3.7 trillion. Here, it's 2 trillion of liabilities that we've got to address over the next 20 or 30 years. There's an enormous amount of business coming our way over those periods of time. And the trends are really operating in our favour.
Nigel, come back. We'll chat for longer next time. Good to see you.
Good to see you.
Nigel Wilson, L&G Chief Executive. Vonnie.
Mark, let's check in now on the first word news. Courtney Donahoe has that.
Hey there, Vonnie. More ammunition for President Trump as he prepares to impose those tariffs on steel and aluminum. The U.S. trade deficit increased more than forecast in January to a post-recession high. Exports fell 1.3% from December. That's the most in more than a year. Meanwhile, the European Union is skeptical of President Trump's justification for those planned tariffs on steel and aluminum. EU Trade Commissioner Cecilia Malmström says she seriously doubts the U.S. wants the tariffs for national security reasons. If Trump does impose the tariffs, the EU will do the same on a wide range of U.S. goods. In the nation's capital, Israeli Prime Minister Benjamin Netanyahu once again urged the world to take a harder line on Iran, saying the nuclear deal with 6 world powers has added to Tehran's increasing dominance across the Middle East. Netanyahu spoke to the Economic Club of Washington President David Rubenstein.
Iran, since the deal has been signed, has been like a tiger unleashed from its cage. The deal emboldened it, enriched it, and instead of joining the community of nations, they're just devouring the nations, one after the other.
Meantime, Netanyahu is fighting off an intensifying corruption probe in Israel. Carlyle co-founder and co-CEO David Rubenstein is the host of the David Rubenstein Show, Peer-to-Peer Conversations, which airs on Bloomberg Television. And Crown Prince Mohammed bin Salman of Saudi Arabia met with Queen Elizabeth at Buckingham Palace. He also met with Prime Minister Theresa May. It's part of a tour of capitals aimed at burnishing the Crown Prince's credential as a leader in waiting. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Courtney Donahoe. This is Bloomberg. Vonnie.
Courtney, thank you. Coming up, tech moves in on lending. How one startup is using artificial intelligence and machine learning to take on traditional lenders. This is Bloomberg.
Live from London, I'm Mark Barson.
And in New York City, I'm Bonnie Quinn. This is the European close on Bloomberg Markets. Let's return now to Goldman Sachs' annual Housing and Consumer Finance Conference. It's underway here in New York. Bloomberg's Julia Chatterley is back with a former Google executive who's shaking up the lending industry. Julia.
Thank you very much, Bonnie. I've got a great stat for you, actually, stolen from my next guest. 83% of Americans have never defaulted, and yet 40 to 50% only have access to what's considered prime or fairly priced credit. That's a huge gap, and into that gap has stepped my next guest. He's the CEO of Upstart, Dave Gerard. Dave, great to have you with us.
Great to be here.
Huge opportunity. Talk to me about how your business works in terms of pricing credit and accessing people that might want to borrow money.
Sure. So we came out of the technology world. A lot of us were ex-Google, and with the sort of idea that there's a lot of improvements that could be made into credit decisioning, who gets access to credit and on what terms. It's been a system that has existed for decades in the U.S. and has been largely unchanged. And truthfully, a far higher percentage of Americans are actually creditworthy if the systems could only recognize it. So what we did is bring a lot more data to the table and apply kind of modern statistical techniques, what's referred to as machine learning, in order to get a much better assessment of risk related to a loan.
What criteria are you talking about? What additional boxes are you looking to tick that traditional lenders haven't?
Sure. So, we started looking at younger people who had thin credit files. They didn't have a lot of history of using credit, and so they were sort of uniformly considered guilty or risky. And we said, no, there's a lot of other information that might help you dispute that. For example, what did they study? Where did they go to school? Where do they work? What industry are they in? So we began to look far beyond the credit information and started to look at signals of their potential.
Did I just delete that video of fucking Goldman putting Gucci gang?
Also look to understand the situation they're in. Are they aware of their credit score? How much are they looking to borrow relative?
You put a fucking video of a fucking toddler in ISIS fucking executing someone.
You can do it in a very automated way.
How much of the loans that you provide now are fully?
Yeah.
Someone can just go online, get access to credit.
Because Snowden used to do that shit all the time and everyone's fine with it.
Our loans, it's rewarded.
It's their culture over there.
Approved and
yeah, true.
The loan without any uploading of documents, without talking to us on the phone. And that's really through automation and data science that we can be sure they are who they say they are, that their credentials are what they claim, and it's worked really well for us.
You've said, and I've seen you've been quoted as saying that actually we misprice credit a great deal. The majority of credit's actually mispriced. I just spoke to the CFO of Loan Depot, the second biggest now non-bank lender in the United States, and they use traditional methods, and he said, look, the science just isn't there. The scientific approach that you guys are talking about and using isn't backed up by the results. You'd argue.
Well, look, if you come from the industry, if you're not a technology person, it's easy to say it's all been invented, it's all been done before. It's sometimes helpful to be coming from the outside with a bit of naivete and say, gee, I think it could be done better. But it's very obvious that knowing more about a borrower is better. Having a better sense of their employment, their stability of their employment in the future, what might happen to them in a recession. It's almost obvious to most people that there's more information than the FICO score out there.
Are you saying then that if you look at the industry as a whole, actually the tech breaking into finance model is superior now than the finance trying to adopt technologies?
Well, you certainly need a combination, and there are definitely financial companies, Goldman Sachs is a great example, who have plenty of engineers, really good technical talent. So it's not as binary as tech versus finance, but for sure, having a depth and a richness of technical capabilities and engineers is a lot of technologies come from that. My company comes from that world, and it'll be interesting as these two begin to merge over time.
What we are seeing, though, at the lower end for unsecured lending in particular, some of the smaller players struggling, the credit cycles shifting, delinquencies are perhaps aren't what they anticipated. Do you expect to see greater consolidation, particularly if we see deregulation to a certain extent and we see some of the medium-sized players get back into the lending market?
Yeah, I do think you'll see consolidation. There was a rush of companies who were able to bring lending online, make it more efficient, easier to get a loan, but they have no sort of sustainable advantage or edge. And so in the end, it's a heavily competed industry. It's a cyclical industry. So if you don't have a real lasting advantage that you can build on, you're going to have a hard time eventually.
What about Amazon? It would be remiss of me to have you here and not talk about the possible Amazon effect, particularly if they're talking about some kind of account information sharing with some of the big banks out there. Do you see them as a potential disruptor in this market of some sort?
I sure do. I mean, as an ex-Google person, I will say that I am just amazed at what Amazon has done in recent years. They have really shown a breadth of ambition, a willingness to take risk, a speed of execution that is really unprecedented. And it seems obvious to me that your personal finance, whether it's where you keep your money, how you invest it, how you borrow, is going to be a central business for Amazon over time. Having said that, it's a big...
I'm surprised by your optimism there. Surely you should be concerned or threatened.
Well, it's a big world, first of all, and I don't think credit or lending is ever going to be truly consolidated into a handful of players. And I'll also say generally, we're the smaller guys. We're growing super fast. It's ours to lose. You don't get disrupted by a much bigger company, even in Amazon. You tend to get disrupted by the next couple of people in a garage. So as long as we keep executing and moving, we'll do well.
You've been originating loans, and I believe for now 4 years, and I believe around 80% of them are people refinancing or getting cash for credit card debt in particular. So I feel like you're at the pulse point of where we are in the credit cycle. What are you seeing in terms of the data here and the performance?
Well, credit card balances, particularly in our demographic, which is millennials, are actually at all-time highs. So there's no shortage of opportunity to help these people who are kind of at a transitional point. Our average borrower is 28 years old. They're usually 90+% are college educated. They have student debt, credit card debt, but they will be in the future wealth creators. We call them future prime. We're just kind of recognizing them before the rest of the world does and getting them on board as customers then. So we see ourselves as a transitional sort of opportunity to move them to a place where they don't have credit card debt anymore. They actually are positive in terms of their balance sheet, and it's a great place to be. Most of our borrowers borrow from us once, which a lot of people won't like, but we like the fact that we are moving them to the next stage of their life.
It's quite fascinating. That's like the antithesis of providing credit to someone. You assume it carries on. Fascinating conversation. Thank you so much. The CEO of Upstart there, Dave Gerard. Bonnie, back to you.
Bloomberg's Julia Chatterley there at that Goldman conference for us all day. Julia, thank you. Mark.
Bonnie, coming up, U.S. Energy Secretary Rick Perry tells reporters in Houston that tariffs are all ongoing conversation. He's not sure President Trump has made up his mind. More on that next. This is Bloomberg. Live from London, I'm Mark Barton.
And in New York, I'm Vonnie Quinn, and this is the European close on Bloomberg Markets. Tariffs, a huge topic at CERAWeek in Houston. Joining us now from Houston is Bloomberg's managing editor for energy and commodities in London. In fact, Javier Blas, who happens to be in Houston for this week. Javier, tell us first of all about the comments that Rick Perry made a few minutes ago. Quite controversial, saying that perhaps the tariffs aren't already baked into the president's intentions.
Yes, surprising comments to reporters here in Houston after he spoke to thousands of oil industry executives in the CERAWeek conference here in the Texan city. He said that the President Trump has not made his mind for sure on steel and aluminum tariffs, and he hinted that there was some kind of internal debate still going on within the administration. Perhaps one of the first signs that actually the tariffs is not a complete done deal. Certainly a lot of opposition here in Houston from the oil and gas industry towards the tariffs.
I just want to have you listen to something that Peter Navarro told us on Bloomberg TV a little bit earlier. Peter Navarro, of course, a top economist at the White House at the moment and one of the people responsible for potentially implementing these tariffs. He says they'll be good for the U.S. economy. Have a listen.
All we're trying to do with the steel and aluminum tariffs, which are very modest in terms of their levels, is to defend those industries. The president said very clearly that we can't have a country without a steel and aluminum industries, and I totally agree with him. And the aluminum industry in particular will go away in just a matter of a few years unless we take the actions that we're going to be taking.
Javier, what does the rest of the world think? You're based in London. I mean, does a country need an aluminum industry to survive?
Well, many European countries don't have an aluminum industry whatsoever, and they should be doing fine. And the comments about the economy from Peter Navarro, it's really the opposite of what I'm hearing here in the Houston CERAWeek conference. All the comments that I'm hearing from senior oil and gas executives is that the tariffs will be bad both for the global economy but also for the U.S. oil and gas industry. I was just a few minutes ago talking to one of the top executives investing in U.S. deep water in the Gulf of Mexico. These are the kind of offshore platforms that require 10, 15, 20,000 tons of steel to be built. And he said, Javier, I'm just not going to sugarcoat. It's bad. It's really bad for us.
Our thanks to Bloomberg's Javier Blas there for jumping on with us from Houston and CERAWeek. Mark.
Bonnie, take a look at where European markets ended the day. It was a day of two halves. The low for the day was 11 p.m. local time, when the Stock 600 was down by roughly 0.6% on the back of concerns emanating from the departure of Gary Cohn from the White House. But look at the rebound. Investors shrugging off those concerns, looking ahead to the big macroeconomic event that's due to take place tomorrow. It's the ECB meeting. We'll be there. We'll be telling you all about it. This is Bloomberg.
you.